Shall we start? We were into accounting standards car revision chartered and we had done AS 1 to 18. Now we'll start with AS 20, AS 19. AS 19 is leases. Correct? Yes, sir. Lease matlab, what is lease? One party gives asset to another party for using it. Correct? Another party gives money to use it, series of payment. One party gets the right to use the asset and another party gets series of payments. This arrangement is done via a contract and such contract is known as lease. I repeat, chartered, there is an arrangement. One minute. Now chartered. Now, so one party gets the right to use the asset, the another party gets series of payment. Such an arrangement is done through a contract and that contract is known as lease. The person who gives the asset or gets the payment is known as lessor. The person who gets the asset and gives the payment is known as lessee. If I talk in your term and my term, then landlord is lessor, tenant is lessee. Sir, it is rent agreement. No. It is a convenient purpose. The person who gives the asset, lessor. The person who gets the asset, lessee. Contract. Lease is an agreement between two parties where one party, lessee, gets right to use the asset and another party, owner, lessor, gets consideration by way of series of payment, that is known as lease rentals for a specified period of time, that is known as lease term. Correct? I repeat, lease is an agreement between two parties where one party, lessee, gets right to use the asset and another party, owner, lessor, gets consideration by way of series of payment, that is known as lease rentals for a specified period of time, that is known as lease term. Correct, incorrect? Correct. Now chartered, let's understand this through a very simple example. Radha Limited gave classroom on rental of rupees 6 lakhs per annum to Dipesh for 5 years. Sir, ye Radha kaun hai? Arey relax baba. Radha Limited gave classroom. So classroom is an asset on rental of rupees 6 lakhs per annum. This rental of 6 lakhs per annum is known as lease rentals. Correct, to Dipesh for 5 years. So Radha Limited gave the asset, he is lessor. Dipesh got the asset, he is lessee for 5 years. That 5 years is lease term at a rental of rupees 6 lakhs per annum. That is, these are known as lease rental, lease payments or minimum lease payments. Acha, these are known as lease rentals, lease payments or minimum lease payments. Correct, incorrect? Correct, sir. Now, chartered. Concept 2, scope. This standard does not apply to three things. Lease agreement to explore and use natural resources. Like ITC got lease, ITC got on lease tobacco jungles from government. ITC मतलब पता है ना? Tobacco. Now chartered, ITC got on lease tobacco jungles from government. licensing agreement of various items such as motion pictures, video recordings, manuscripts, patents, plays. All these are intangible assets. Like PVR gets a movie theater gets a right from the producer. PVR got license to show mobile from distributor. PVR got license to show movie from distributor. Then student got license from teacher to view the lecture. All these are also right to use the asset, and there is a payment involved, correct, but these are not lease agreements. Lease agreement to use rent, ground on lease from owner to run cricket academy. Rahul Dravid took a ground on lease where he runs a cricket academy, or Shehwag, now to Shehwag has purchased the ground, but otherwise. So understood, three things are out of scope. One is natural resources, one is intangible asset, that is movies, scripts, all that, and third is land, which are out of purview of lease. So you understood what is lease? Yes, sir. You understood lesser, lessee, lease term, yes. Then lease rentals are also known as lease payments or minimum lease payments, correct. Three things are out of scope of lease. What are those three things? Sir, first is natural resources ka lease, correct. Second is licensing agreement of movies, manuscripts, patents, intangible assets, correct. And third is lease agreement of land. Very good. Some important terms. 1, 2, 3 terms. 1, 2, 3 terms. Non-cancelable lease. What is non-cancelable lease started? Non-cancelable lease is a lease which can be cancelled only upon occurrence of some remote contingency. Is a lease which can be cancelled only upon occurrence of some remote contingency. That means non-cancelable lease means the period for which the non-cancelable lease means the lease which cannot be cancelled. But obviously anything cannot be cancelled, that cannot be the case. So it's a lease which can be cancelled, but under special situations. What are those special situations? 4 situations: A, B, C, D. It can be cancelled upon occurrence of a remote contingency. Acha. Remote contingency, death, natural calamity, death of a lesser or lessee, or natural calamity, tsunami, flood, property only got destroyed. With permission of lesser. So it can be cancelled on remote contingency, yes. On permission of lesser, yes. If lesser enters new lease agreement for same asset with lessee. If lesser enters new lease agreement for the same asset with the lesser. 11 months ka lease. So first lease got over, second lease started. So first lease got cancelled, second lease got over, third lease started. Renewal agreement, so old agreements get cancelled. Upon payment by the lessee of the additional amount such that at inception continuation of the lease is guaranteed. That means we entered into lease for 5 years, but we wanted to extend this for a period of 3 years. So at inception only we gave them say 50,000 extra to continue the lease for the extended period, and the lease rent for the extended period will increase by say 5%. Fair enough. So are you understanding? So 5 years, after that lease will continue and go into the next period. Correct? So the old lease gets cancelled, the new lease gets started. So chartered, under 4 situation, non-cancelable lease can be cancelled. Number 1, upon remote contingency. Number 2, upon with permission of the lesser. Number 3, when lessee enters into new agreement with the same lesser for the same property. Or number 4, upon payment by the lessee of additional amount such that at inception continuation lease is reasonably certain. Correct? So 5 years ka lease agreement we entered. 3 years ka extension I wanted. So initially I paid 50,000 extra and told that I will continue the lease for additional 3 years at extra 5% lease rent. So after 5 years, the old lease will get cancelled and new lease will start working. Am I clear? Yes, sir. Lease term. Lease term is non-cancelable period plus renewal period. Non-cancelable period plus renewal period. Renewal period for which option is with whom? Lessee. and lessee is reasonably certain to exercise the option. Non-cancellable 5 years, plus I can extend the lease for 3 years. Who can extend the lease? Lessee. Am I clear? And lessee is reasonably certain that I will exercise, then the lease term will become non-cancellable period plus renewal period, else only non-cancellable period. So lease term is generally non-cancellable period. Renewal period should be added, should not be added. Renewal period chartered should be added only and only if the option of renewal is with the lessee and lessee is reasonably certain that he will renew the lease. Am I clear? And lessee is reasonably certain that he will renew the lease. Am I clear? Yes, sir. Now, chale chartered. Yes. Now, Virat took a property on lease from Anushka. Oh my God. For a period of 5 years, which has the option with Virat. So, who is Virat over here? Lessee. On lease from whom? Anushka. So, Virat is lessee, Anushka is lesser for a period of 5 years. That is lease term, correct. With the option, so non-cancellable period is 5 years. With option with Virat. Who is Virat? Lessee. So, lessee should have the option over here. Option is with whom? Virat. To renew the lease for a period of 3 years. If Virat is reasonably certain to exercise the option, then lease term is equal to initial 5 years plus 3, 8 years. If Virat is not reasonably certain to exercise the option, then lease term is equal to 5 years. Correct, incorrect? Correct. Now, charter. Inception of lease. What of lease? Inception of lease. That means which day we would consider that lease have started. Date of agreement or date of commitment. Date of commitment means date when asset has been started to use. That means I have given the asset and you have started using it, or date of agreement, whichever is earlier. Sir, can commitment start before agreement? You are asking me. God knows in your life when agreement will sign, but your commitment has already started. So you will say that you all are together. You will say that you all are together from the date of agreement or from the date of commitment. Oh, understood. Yes or no? Yes, sir. Good morning, Rahul. Now, types of lease. There are two types of lease. One is known as finance lease, one is known as operating lease. Finance lease is basically we are buying things on installment. So if you are buying things on installment, we call it finance lease. If you are taking a property on rent, we call it operating lease. So fundamentally different is this. In both the cases, we are getting the property to use, and in both the cases, we are supposed to make series of payment. But in one case, we are basically becoming the owner of the asset. In another case, we are just using the asset for a period of time. It's a rental agreement. We do not have control over the asset. So over here, risk and rewards attached with the ownership are not transferred. In case of operating lease, risk and rewards attached with the ownership are not transferred, but over here, risk and rewards attached with ownership are transferred. In this, risk and rewards relating to ownership are transferred to lessee. Basically, purchase, sale of lease on installment basis. This entire thing. In this, risk and rewards relating to the ownership are not transferred to lessee. Basically, giving and taking asset on rent. Am I clear? Yes, no, yes, sir. Now, my wonderful chartered accountants, are you listening? Are you understanding? Finance lease. Finance lease has how many conditions? Finance lease has 5 conditions. If any one of the 5 conditions you fulfill, it is finance lease. Else it is an operating lease. Sir, any one condition we fulfill, it's a finance lease. Yes. Any one condition if you fulfill, it's a finance lease. Else it's an operating lease. Acha. Lessee will become the owner of the asset at the end of lease term by default. Acha. Lessee has the option to purchase the leased asset at the end of lease term at less than fair value. At less than fair value. Correct or incorrect? Correct. Lessee has the option to purchase the leased asset at the end of lease term at a price lower than the fair value of the asset. Correct? That means ultimately he will give a fair value of the asset, not original asset, that second hand asset. So I've used the asset for 10 years. After 10 years, the fair value is almost equal to scrap value. So lessee will pay the scrap value and take the asset. Am I clear? So in the first case, lessee will become the owner of the asset at the end of lease term by default. In second case, lessee will become the owner of the asset at the end of lease term by paying a amount which is lesser than the fair value. Correct? Mr. A has taken a car on lease for 5 years. Mr. A has taken a car on lease for 5 years for XYZ. After 5 years of lease term, Mr. A has the option to purchase the car for 20,000. Where it is assumed that the market value at the end of the year is 2 lakh. 2 lakh or 20,000. Oh my God. Considering the option to buy at a bargain price, it is reasonably certain that A would exercise that option. Leased asset is of specialized nature such that only lessee can use the asset. Leased asset is of specialized nature that nobody apart from lessee will use it. Generally, ambulance. PQR, a hospital ordered 10 ambulances specially designed as per the requirements of PQR. These ambulances are taken on lease and it cannot be used by anyone else without major modification. This would meet the condition of finance lease. Yes or no? Yes, sir. So we have studied 3 conditions. Lessee will become the owner of the asset at the end of lease term by default. Second condition, lessee has the option to purchase the leased asset at the end of lease term at a nominal amount at a very small value at lesser than the fair value. Number 3, asset is so specialized in nature that nobody apart from lessee will be able to use the asset without major modification. Number 4, lease term is for major part of economic life of the asset. If the life of the asset is 10 years, leased is for more than 6 years or 5 years. Acha. XYZ has taken a property on lease for 32 years from ABC. Expected economic life of the property is 40 years, out of which 32 years are with XYZ. That means 60%. Since XYZ is going to use the asset over a major part of its economic life, that is 80%, it will meet the condition of finance lease. Correct? Sir, major part ka definition. But a major part ka definition is greater than 50%. The asset is for 10 years. And if the lessee takes the asset for more than 5 years, we assume it's a finance lease. Correcta, incorrecta, correcta. Now, at inception, present value of MLP covers substantially 90% of fair value. For example, Rita owns a car, gave a car of rupees 10 lakh to Romeo at rupees 4 lakh for 3 years. So here, lease rental, present value factor at the rate of 10%, present value of minimum lease payment, how many years? 3 years. Year 1, 2, 3. Lease rentals are 4 lakhs. Present value factor at the rate of 10%, 0.9091, 0.8264, 0.7513. So chartered, let's calculate the minimum value. 4 lakhs into 0.9091. 3 lakh 63,640. Then 4 lakhs into 0.8264, 330,560. then 4 lakhs into 0.7513, 3 lakh 520. So present value of lease payments is equal to plus 330, 560 plus 363, 640. You also check chartered 994, 720. Correct? Now, present value of MLP by fair value. By fair value into 100. Now, so this is 994, 720 divided by 10 lakhs into 100 is equal to 99.4%. Therefore, it's finance lease. Correct. So present value at inception, at starting, you check the present value. At inception, present value of minimum lease payments covers substantially 90% of fair value. Then it's a finance lease. Correct? So how many conditions are there charted? 5. Condition number 1. What is condition number 1? Lessee will become the owner of the asset at the end of lease term by default. Number 2. Excuse me. Number 2. Lessee will become the owner of the asset at the end of lease term by making a nominal payment lesser than the fair value. Number 3. Lease term is equal to major part of the economic life of the asset. Correct? More than 50%. Sorry, number 3 is asset should be of specialized nature that nobody apart from lessee can use it. Correct? Yes. Number 4, lease term is equal to major part of the economic life of the asset. Correct? Number 5, present value of MLP should cover substantially fair value of the asset, that is 90% of the asset. Yes sir, no sir, yes sir. Now, finance lease. Understand few terms. So we enter finance lease. Now, what is operating lease then? Any lease which is not a finance lease is an operating lease. Any lease which is not a finance lease is an operating. And any lease which does not satisfy these 5 conditions, any one of the 5 conditions, not all, any one of the 5 conditions is a finance lease. Concept 3. Finance lease, residual value. Understand this residual value. Now, chartered. You gave me this asset. ठीक है ना, ये asset दिख रही है? Yes sir. This asset you gave it to me and I was using it. After the lease term, you told me, Dipesh, if you want to keep this asset, no, you are supposed to pay me 10,000 rupees. So that is the residual value you are expecting from me. Are you understanding? That is the residual value you are expecting from me. How much you are expecting from me? 10,000. That is known as residual value. I tell you, okay, situation 1, I tell you, okay, done, I will give you 10,000. So your expected residual value was how much? 10. How much I have guaranteed? 10. So can I say expected residual value and is guaranteed residual value? Whatever residual value you expected, I have guaranteed that I will give. Or if not me, somebody else told, my brother told, my friend told that they will buy this asset for 10,000 at the end of lease term. So ultimately, lessor got a guarantee that from lessee he will get lease rentals and at the end of lease term he will get residual value also. That residual value which lessee has guaranteed, that residual value which lessee has guaranteed or anybody on behalf of lessee has guaranteed is known as guaranteed residual value. Correct? Yes. That means now understand the crux. What is the residual value of this asset? So 10,000. Matlab this is worth 10,000. Yes or no? Yes, sir. Either I give you this or I give you 10,000 in cash. It is one and the same. Ha, sir. Whether you give me this asset or you give me 10,000, it is one and the same. Wonderful. Aage badhe? Ha, sir. Situation 2. You told me, Dipesh, if you want to buy this asset at the end of lease term, then you are supposed to pay me 10,000. That means your expected residual value is how much? So 10,000. I say, nah, I will give you only 8. I say, nah, I promise you only 8. Correct? You say, no, Dipesh, you have to give 10. I say, I promise 8. At the end of lease term, we will see. You say, okay. Now, chartered, your expected is how much? 10. How much I have guaranteed? 8. How much I have guaranteed? 8. So, guaranteed residual value is 8. Now, lease term gets over. If somebody is ready to pay you 10, then I may pay extra 2. Yes or no? Yes. But that 2, did I guarantee at the beginning of the lease? No. So, that 2 is guaranteed or unguaranteed? Unguaranteed. You are expected 10. I guaranteed 8. At the end of lease term, somebody else is ready to pay you 10. So, I told, okay, I will only give you 10. So, 8 I had guaranteed plus 2 I am giving you extra which I had not guaranteed. So, unguaranteed is how much? 2,000. Correct? You tell me, Dipesh, somebody is ready to give me 10. I tell, let that somebody give you anything. Let that somebody give you anything. I am not going to give you. He tells, okay. You give back the asset to me. I said, okay. Take the asset. So, what is this worth for me? 8,000. So, I give him 8,000. So, he got value worth 8,000 from me which was guaranteed. He sold it in the market and got 10. So, 2,000 he got extra which is unguaranteed. Are you understanding? Yes or no? Yes, sir. So, at inception he wants how much? 10. How much I have guaranteed? 8. How much is unguaranteed? 2. That 2 either I may give, yes, or the market may give, yes, or at the end of lease term he tells, Dipesh, somebody else is ready to give me 10. I'm like, le ja asset, you take the asset. I am ready to give you 8 only. He said, okay, Dipesh, give me 8 only. So I give him 8 and take it back. But his expected was how much? 10. Guaranteed was how much? 8. I gave him 2 unguaranteed. Did he get? No. So 2 is unguaranteed, which at the end of lease term, he may get, he may not get, he may get more than that, he may get less than that. But for that, we have to wait till the end of lease term chartered. Is that clear? So, expected residual value minus guaranteed residual value, that guarantee is given by lessee or any other person on behalf of lessee. My brother, father-in-law, sister-in-law, brother-in-law. Am I clear? Yes, sir. Now chartered. Shall we move ahead? Sir, I am CA foundation student. What are you doing here, hero? Now, so chartered, residual value. Foundation, study for foundation exam. Gyani? Now, residual value guaranteed any committed amount by lessee or any third party to lessor at the end of lease term, or any third party to lessor at the end of lease term. Now, unguaranteed means estimated residual value minus guaranteed. Lessee pays what? Lease rentals and GRV. So, lease rentals plus GRV is equal to minimum lease payments. Lease rentals plus GRV is equal to minimum lease payment. This you should die but not forget. Till your last breath chartered, you should remember. Am I clear? Yes or no? Yes, sir. What is that? Lessee pays lease rentals and GRV. Lessor receives lease rentals plus GRV plus UGRV. Now, chartered, tell me honestly, lessor receives lease rentals plus GRV plus UGRV, yes or no? Lesser receives lease rentals plus GRV plus UGRV. Yes or no? Lease rentals plus GRV is also known as minimum lease payments. Therefore, we can say lesser receives. Therefore, we can say lesser receives chartered minimum lease payments plus UGRV. Minimum lease payments plus UGRV. Correcta, incorrecta? Correcta. Now, whatever lessee pays is known as minimum lease payment. Whatever lesser receives, that is minimum lease payments plus UGRV, that is known as gross investment. What does lesser receives? A lesser receives lease rentals plus UGRV lease rentals plus GRV plus UGRV. I hope this point is clear, that lessee gives lease rentals plus GRV. Lesser receives lease rentals plus GRV plus UGRV. That is MLP plus UGRV. Fair value is known as market price of the asset, also known as cost of the asset, because for one it is fair value, for one it is cost also. Now, few important points. MLP does not include contingent rent or variable rent. Contingent rent or variable rent. That means rent is 50,000 plus 2% of sales. Oh. Or 300 hours per hours worked. No, there is no variable. 2% of sales, 2% of profit, nothing. That is variable. That is contingent rent. That is not a part of lease agreement. That is royalty. Discounting rate or interest rate means the rate at which. This is charted very, very important. Discounting rate or interest rate. Discounting rate chartered or interest rate means present value of lease rentals plus GRV plus UGRV is fair value. That rate of interest chartered where present value of gross investment, this is gross investment only, no? Present value of gross investment is equal to fair value. Discounting rate is also known as implicit or internal rate of return, IRR. In initial direct cost paid, that means expenses incurred directly for starting the lease. By lesser, if the initial direct cost, whatever is paid by the lessor, will be transferred to P&L. Whatever is incurred by the lessee will be capitalized. Whatever lessor incurs, that will be transferred to P&L. Whatever lessee incurs, that is transferred to the cost of the asset. Initial direct cost. Am I clear? Yes? No? Yes, sir. Now charted. Aage bade? Yes. So you are supposed to understand few things over here. First, what is residual value? Guaranteed, unguaranteed. Understood? Lessee pays two things. GRV, lease rentals and GRV. Lesser receives three things. What are the three things? So lease rentals, GRV, UGRV. GRV plus UGRV plus lease rentals, all three put together is known as gross investment. So generally I say gross investment ke do formulae. Generally I say gross investment has two formulas. What are those two formulas? Lease rentals plus GRV plus UGRV or MLP plus GRV, MLP plus UGRV. What is MLP? MLP is nothing but lease rentals plus GRV. I hope this This all equation should be very, very clear in your mind. Yes, sir. Third is fair value. Fair value is the market value of the asset, which is nothing but cost to lessee. Correct. Now, first important point. MLP does not include, or lease rentals does not include contingent or variable rate. Second, rate of interest is nothing. Present discounting rate is that rate of interest at which present value of gross investment is equal to fair value. Present value of gross investment should be equal to fair value. Achha. And present value of gross investment is also known as net investment. So net investment and fair value are same. Oh, discounting rate or rate of interest means that rate of interest at which present value of gross investment is equal to fair value, that is nothing but net investment. Discounting rate is also known as IRR, that is implicit or internal rate of return. Initial direct cost, if incurred by lessor, will be transferred to P&L. Incurred by lessee will be added to the cost of the asset. Steps to solve. Must? Huh. Step 1, check and calculate the missing figures. Step 1, check and calculate the missing figures. Fair value. Now charted. Fair value and lease term will always be given in the question. If it is not given in the question, there is a problem in the question. GRV, UGRV. If given, very good. If not given, 0. Lease rentals. If given, very good. If not given, calculate. IRR. If given, very good. If not given, calculate. So, charted, these two are interesting. Lease rentals, rate of interest, and IRR. So, fair value and lease term will always be given. GRV, UGRV, given, very good, not given, assume 0. Lease rentals and rate of interest. Lease rentals and rate of interest. If given, very good. If not given, calculate. If it is not given, it has to be calculated. So, step 1 may you check the missing figure. Correct? If there is a missing figure of lease rentals or IRR, then you are supposed to calculate. Using this logic, present value of gross investment is equal to fair value. Okay. Step 2, lease table. Lease table is very, very important. LR, GRV gives you MLP. सबका present value निकालेगा तो present value of MLP you will get. So this is MLP. This is present value of, this is MLP. This is present value of MLP. Present value of MLP divided by fair value into 100. If it is greater than 90%, it is finance lease. MLP may if you add UGRV, then it will become gross investment. Present value of UGRV, if you add, it will become net investment. So, charted till year. Understand, till year. It is from lessee's point of view, lease rentals plus GRV. Add UGRV, it will become from lessor's point of view. If they ask you in the question, what is cost of asset or what is lease liability? What is cost of asset or what is lease liability? Asset is from whose point of view? Lessee's point of view. Lease liability, who has to pay? Lessee. So, if they ask you cost of asset or lease liability, then you are supposed to think from whose point of view? Lessee's point of view. Very good. Then you are supposed to think from whose point of view? Lessee's point of view. That is lower of present value of MLP or fair value. You will pay what? Fair value or present value of MLP, whichever is lower. So remember, if in the question they ask you, please calculate cost of asset or lease liability, then you will calculate lower of present value of MLP or fair value. Correct? If they ask you, check whether it's an operating lease or finance lease. Present value of MLP divided by fair value into 100. Greater than 90%, then finance lease, else operating lease. Unearned finance income. Unearned means yet to be earned. Unearned means yet to be earned, chartered. yet to be earned. Unearned means yet to be earned. Now, who will earn finance income? Lessee or lessor? So, lessee will pay interest, lessor will get interest, therefore, lessor will earn unearned finance income. Yes, genius. What is his unearned finance income? Gross investment minus net investment. This is unearned finance income, that is income yet to be earned. So, he will earn this income over the period of lease term. This is just a calculation and disclosure purpose, this is not accounted. Achha. Gross investment minus net investment is the interest income, finance income which lessor will earn throughout his lease term. It represents 5 years total interest income of lessee. This is not accounted, it is just for disclosure purpose. It represents 5 years Q. It represents lease terms, total interest of lessor. This is not accounted, it is just for disclosure purpose. Calculation of interest. Now this is important. You are calculating interest from whose point of view? Lessee or lessor? Sir, both के लिए rate of interest will be same, IRR. Remember, both के लिए rate of interest will be same, that is IRR. But both का amount of interest will be different. Both का opening balance will be different. Because one के लिए starting point is present value of MLP. But another के लिए, lesser के लिए starting point is present value of MLP plus present value of UGRV. That is net investment. So for lessee, starting point is present value of MLP. For lessor, the starting point is fair value, net investment. Am I clear? Because there is a difference between lessee and lessor on one point. That is UGRV. Oh. So calculation of interest, opening balance. If you are calculating interest from lessee's point of view, you will start with present value of MLP. If you are from lessor's point of view, you will start with net investment. Opening balance, interest on opening balance minus installment is equal to closing balance. Opening balance plus interest minus installment is equal to closing balance. That will become opening plus interest closing. As soon as you reach last year may remember closing balance. If you are from lessee's point of view, then GRV is the closing balance, which he may give, he may not give. Because suppose you told 10,000, I told 8,000. You told 10, I told 8. So I have guaranteed how much? 8. At the end of lease term, is it guaranteed that I have to give 10? No. I have to give 8. If you agree, very good. If you do not agree, then I will give you 8 in cash or I will give you the asset back. Sir, you will give me the asset back. Exactly. Now, one more interesting question. Please remember. Suppose chartered, you gave me the asset. You told Dipesh, I expect a residual value of 10,000. I told no, 8,000. Correct? We decided we will check this at the end of the lease. At the end of the lease, you told Dipesh, I want 10. I told, nah, 8. You told, then give me back the asset. I told, okay, take it back. So I gave you back the asset. In such a situation, it is a finance lease or operating lease. If the asset reverts back, to the lessor, it is finance lease or operating lease. Oh my God, it's an operating lease. No, it's a finance lease. Why? Nowhere in finance lease it is stated that asset should stay with lessee only. Condition 1, lessee will become the owner of the asset by default. So condition 1, lessee has the option to purchase the asset at the end of lease term at a residual value. Correct? Option. He may not purchase also. No? He should have the option. So over here he had the option to purchase at 10. Okay. Number 3, out of 10 years I am using the asset for 7 years, and after 7 years the asset reverts back. Then still it's a finance lease. The asset is of specialized nature, and after the end of lease term the asset goes back. Oh. Present value of MLP is greater than 90% of the fair value of the asset. Asset will go back. So that is not a yardstick that asset should stay with lessee. Remember this. Okay. So again, let's come back to last year mein charted this closing balance. If you are doing from lessee's point of view, it is GRV. If you are doing from lessor's point of view, it is GRV plus UGRV. This closing balance, and this interest will become balancing figure. Last year ka interest. So in this interest cut table, point number 1, interest cut table is opening balance plus interest minus installment is equal to closing balance. Point number 2, opening balance from lessee's point of view is present value of MLP. From lessor's point of view, it is net investment. Point number 4, in the last year closing balance from lessee's point of view is GRV, from lessor's point of view it is GRV plus UGRV. Even in case of finance lease, the asset can revert back to lessee. Asset can revert back to lessor. The asset, it's in finance lease, it is not mandatory the asset should stay with lessee only. No. After the lease term, 90% of the time asset was with me. At the end of lease term, the asset went back to lessor. No problem. Is this clear? Yes or no? Yes, sir. Bolo. And last year ka interest is balancing figure. One more important thing. Suppose closing balance is 500, first year ka. So this 500, suppose lease term is 5 years. So this 500 we generally believe is long term. So we treat it as non-current liability. Now relax and listen. This 500 chartered is for 5 years. Yes. So we believe it's long term. Yes. But wait. Next year ka table mein this comes to 300. So can I say this year, understand what I am trying to say, chartered this year end may it is 500 liability. Next year end may the liability is 300. So is this entire 500 non-current or only 300 was non-current? Because out of 500, if it has become 380, year end 1 may it is 500, year end 2 may it is 380. That means from 500 it became 380, that means 120 liability is paid off in the next year. So can I say that entire 500 is non-current liability? Na bapu, na. Are you understanding? At the end of year 1 it is 500. At the end of year 2 it is 380. Can I say entire 500 at the end of year 1 is current, non-current liability? No. Because out of that 500, if next year end May, it is 380. That means 120 I have paid off in the next year. That means out of 500 my liability, 120 paid off in next year is current liability. 380 which is not paid off in next year, that is non-current liability. Because if I am asked to prepare financial statement, then this breakup will help. 500 mein, whatever is next year ka liability, that will become non-current, rest will become current. Am I clear? Now, समझा के लाइन? Like, share, subscribe, please. Now. Yes, sir. So step 1 mein, sir, will check the missing figures. Lease fair value and lease term will always be given. GRV, UGRV will be given. If it is not given, assume 0. Third is IRR and lease rentals. If not given, you are supposed to calculate, and the basis of calculations are present value of gross investment should be equal to net investment. Rate of interest at which present value of gross investment should be equal to net investment. Correct? Yes. Thereafter, chartered step 2 may we prepare lease table. That is date, particulars, amount, present value factor and present value. First we write lease rentals plus GRV. We will get MLP and present value of MLP. Add UGRV, present value of UGRV. We'll get gross investment, net investment. Very good. Third point charted. Check whether lease is finance lease or operating lease. Present value of MLP divided by fair value into 100 is greater than 90% finance lease, else operating lease. Unearned finance income, that is the total interest income which lessor will earn in entire lease life or lease term. That is gross investment minus net investment. That is unearned income. That means income yet to be earned. This is the income we know. This is we disclose, but we don't account for it because this is yet to be earned. Then charted step 3 mein our objective is to calculate interest. So we prepare a calculation of interest ka table. How does that table work? Opening balance plus interest minus installment closing balance. Opening balance, if you are calculating interest from lessee's point of view, then opening balance is present value of MLP. If you are calculating from lessor's point of view, it is net investment. Fair enough? Yes. Second point. Current year ka closing balance, next year ka closing balance. Current year ka closing balance, say suppose 1000. Next year ka closing balance 800. So out of that 1800, which is next year ka closing balance, is your non-current liability, and 200 is the amount which you have paid off in the next year. 200 is the amount which you have paid off in the next year is current year ka current liability. So 1800, so out of 1800 is non-current liability. 1000 became 800 because 200 is the amount which you paid off in the next year. The amount which you paid off in the next year is current liability of current year. Correct? Yes. Closing balance. At the end of last year, closing balance from lessee's point of view is GRV, from lessor's point of view it is UGRV. Last year ka interest is balancing figure. Correct? Now charted. In the books of lessee, are you liking it? Understanding? कुछ comment ही नहीं करता है, you don't talk only. This is not good, no? In accounting, in the books of lessee, year 0, that is day 1 when the asset was taken, leased asset to leased liability, asset coming to leased liability, lower of present value of MLP or fair value, lower of present value of MLP or fair value, finance, correct? Then interest, finance charge to lease liability to bank. So interest to liability, liability to bank. Every year I will go on passing. Then depreciation. Correct? In the books of lessor, lease receivable to asset. Lease receivable, the money is receivable from lessor to the asset which I have given. Lower of net investment or fair value. Interest is income over here, so lease receivable to interest and bank to lease receivable. Correct? Accounting is simple. Yes or no? Yes. What they can ask you? They can ask you calculate the cost of the asset or calculate the lease liability, that is nothing but present value of MLP or fair value, whichever is lower. They can ask you unearned finance income. They can ask you accounting for first year. Correct? They can ask you cost of the asset. And they can ask you interest of each year, and they can ask you to calculate lease rentals or IRR. Fair enough, that was for your finance lease. Now chartered operating lease. Operating lease. Operating lease is a lease which is not a financing lease. Finance lease, that means it did not satisfy any one of the 5 conditions also. Okay. If it had satisfied any one of the 5 conditions also, it would have become finance lease. It does not satisfy any one of the conditions of finance lease. Lessee has the right to use the asset without control over the asset, and control over the asset lies with lessor. Lessee is, it's now basically a rent agreement. So lessor has the control. Lessor will show the asset in its balance sheet. Lessee does not have any control. Tenant does not have any control. Tenant will not show the asset in its balance sheet. Depreciation will also be charged by landlord, that is lessor. So lessor will show the asset, lessor has the control, lessor will charge depreciation. Lessee does not have control, lessee will not show the asset, lessee will not charge depreciation. Lease rental is income for lessor and expense for lessee. Leased asset will be disclosed as PP by lessor and lessee will not show leased asset as asset, that we have discussed. Depreciation will be charged by lessor. This is most important. Depreciation should be charged in the ratio of benefit derived from the asset. Depreciation should be charged in the ratio of benefit derived from the asset. If you believe that benefit is equal, then you charged equally, that is SLM. If you believe that the benefit is not equal, it is based on the output, then in the ratio of output. Correct? Yes. So depreciation will be charged by lessor. Depreciation of the asset should be in the ratio of benefit derived. In the ratio of benefit derived can be, if you believe that equal benefit is derived, then equally SLM, or in the ratio of output. Lease rent is treated as income by lessee and income by lessor and expense by lessee. Total lease rent should be, this is very important point. Total lease rent should be charged to PL every year in the ratio of depreciation. Oh my God. For example, this point clear, lease rent is 40,000, 70,000, 1,30,000. So total lease rent is how much? 2,40,000, 2,40,000. Lease rent equalized. Lease rent equalized means lease rent that will be charged to P&L. Lease rent equalized means lease rent that will be charged to P&L is equal to 40,000 plus 1,30,000 divided by 3 years. So 40 plus 70, 1,10,000, 1,10,000 to 40, that will become 80,000. Correct? In the books of lessee. In the books of lessee chartered, the journal entry will be how much rent you will pay or receive. 40. So this is known as actual rent. Lease rent charged to P&L is lease rent equalized. Actual rent is the rent you pay. Lease rent equalized is the rent which you transfer it to P&L. Acha. So this is my lease rent, which is nothing but actual rent. In the books of lessee के लिए this is an expense. Yes. So what will lessee write? Lessee will pass the entry lease rent. How much? $80,000 to lessor 40,000. Lease rent to lessor. Lease rent to lessor. The difference is how much? 40. That will go to lease equalization account. Oh. Then I will make the payment. Lessor to bank. How much? 40,000 is the payment which 40,000 is the amount which I will pay to bank. Correct? 40,000 is the amount which I will pay to bank. Now chartered. And then PL to lease rent 80,000. Correct? Yes. Now, next year. Next year actual lease is how much? 70. But lease rental I will write 80 to lease equalization to lease equalization. How much? Sorry. Lease rental 80 to lesser. Lesser, I'll write actual rent. Actual rent is how much? 70. So to lease equalization, how much? 10. How much you will pay to lesser? Lesser ko you will pay actual rent. Actual rent is how much? 70. So you will pay 70. P&L mein you will transfer 80 only. Correct? Thereafter charted lease rent 80 to lesser. How much? Lesser ko you will pay actual rent. Actual rent is how much? 1,30,000. Lease equalization 50. How much you will pay to lesser? How much you will pay to lesser? Actual rent. Actual rent is how much? 1,30,000. How much you will transfer it to P&L? Na, 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 na. Correct? Yes. Total lease rent should be equal to, if you want to find out lease rent, then total lease rent charted, cost of the asset plus profit margin, that is your total lease rent. Journal entry for transferring asset on lease. Suppose I am a dealer of mugs. So mugs are goods in trade for me. So when I purchase mugs, I pass the entry purchase to cash bank creditors. Yes. Then out of that mugs which I have purchased, 2 mugs I give it on rent. So those 2 mugs from my purchase will decrease, and since I have given it on rent, it will become my investment property. It will become my asset. So purchase I will take out 2 mugs and put it in PPE asset. So the journal entry will become PPE to purchases. Correct? Yes. Step 1, calculate total lease rent for lease term. ठीक है. Step 2, lease rent table, year, actual lease rent, that is total lease rent divided by lease term. Lease rent charged to PL, total lease rent in the ratio of output, and then do the accounting. Correct? Yes sir, no sir, yes sir. I repeat. How to calculate the total lease rent, cost of the asset plus profit margin, that is total lease rent. Then you will calculate total lease rent for lease term. This is total lease rent for say 10 years or for total output of 5 lakh units. But lease term ka output is only 3 lakh units. So 3 lakh units ka what is the lease rent, that you will calculate. So over here suppose it is 3 lakh plus 20%, that suppose comes to 3,60,000. This is the total lease rent for output of 2 lakh units. Output of 2 lakh units in 5 years, and we have taken, 8 years, 2 lakh units, and rent is 3,60,000. We are taking asset for 3 years only. So 3 years mein we are going to produce 80,000. So uska lease rent will be how much? 8 years, 2 lakh units, 3,60,000 is the lease rent. Then 3 years, 80,000 units, what is the lease rent? See 40%, so 40% will become 1,44,000. This 1,44,000 divided by lease term 3 years will give us actual rent. This 1,44,000 in the ratio of output will give you lease rent charged to PL. This actual rent you are supposed to pay, this is charged to PL. Am I clear? Yes sir. Now. Sale and lease back. Sale and lease back. Now charted. A sold the asset to B. A sold the asset to B. B again leased it back to A. So I had an asset, I sold it to you, I made a profit, then I took the same asset back from you on lease. In this part, we are just supposed to think, see again, I am who? Seller lessee, seller lesser. Seller lessee. I sold the asset, took it back on lease. So when I sold, I made a profit. How to account for that profit? Carrying amount or book value, our objective is to learn the treatment of profit or loss on sale of PP. Now when I sold the asset, I made profit, and profit is equal to selling price minus carrying amount or written down value. Now when I took the asset back on lease, it can be on finance lease, it can be on operating lease. If I had taken the asset back on finance lease, then chartered entire profit should be amortized over lease term. Whatever profit I made should be spread over the period of lease term. If it is operating lease, then you have to check the price at which I sold you, that is the selling price. That selling price is more than fair value, less than fair value, equal to fair value. If the price at which I sold you is less than equal to fair value, less than equal to market value, that means it's a distressed sale, I was in need of money. Then I will recognize profit immediately. Selling price is less than the fair value. But if selling price is more than the fair value, that means the extra money which I am taking is nothing but loan only. Why will you buy it from me at higher price? You are giving me loan. If you are giving me loan, so I am supposed to, logically sochna, I am supposed giving you 100 rupees ka asset at 120. That means 20 rupees you are giving me as loan. So I am supposed to repay you 100 rupees for the asset. So lease rental for 100 rupees. And I am supposed to repay this 20 rupees also, no? Installment. So basically, lease rental will be included of installment also, this profit also. So when I am writing in PL, I will write 20, suppose 4 years ka, 25 plus 4, 25 plus 4, 25 plus 4, 25 plus 4, 29, correct? Plus 5, sorry. I am repaying principal, I am paying you lease rent for this, and I am paying 20 rupees extra. So 30 rupees, so that is why this profit should be amortized. So if I have sold it above a fair value, then the profit up to carrying amount 20 rupees is no problem. But extra profit, selling price minus carrying amount is equal to total profit. Yes. Fair value less carrying amount, this 20 rupees, this 20 rupees extra normal profit. Fair value is 100. Selling price 120. Carrying amount was 90 rupees. That means in my books it was appearing at 90. So this 10 rupees profit is allowed. This 20 rupees profit is disallowed. Total profit I made is how much? 130 120 minus 90. 30 rupees ka total profit I made. Yes. This 30 rupees ka profit message charted 10 rupees the profit allowed. So 10 rupees I will recognize immediately. Extra profit how much? 20. That I will recognize over lease term. Oh. Fair value less carrying amount. Fair value 100 less carrying amount 90. Should be recognized immediately. Selling price less fair value. Selling price 120 less fair value 100. Should be recognized immediately. Understood? Yes or no? Yes, sir. Now chartered. With that we come to end of lease. Now we will do what? EPS. Earning per share. Earning per share, it's a primary ratio which has to be disclosed and the face of PL. It is a primary profit ratio which has to be disclosed on the face of PL. Correct? Now chartered, how many types of EPS are there? 2. One is basic EPS, one is diluted EPS. How to calculate basic EPS, how to calculate diluted EPS? This is the only concern in our entire chapter. So let's start with basic EPS. Basic EPS is calculated as earning available to equity shareholders, that is Dipesh, divided by weighted average number of equity shares vain. So if what is basic EPS? ETH divided by vains. Acha, how to calculate ETH? Earning before interest and tax? Yes. Minus interest? Yes. That is earning before tax? Yes. Less tax. Earning profit after tax? Yes. This profit belongs to whom? So profit after tax belongs to owner. Logically, if you see, no, earning before interest and tax belongs to whom? This belongs to lenders, this belongs to government, this belongs to owner, and this belongs to company. 4 people this belongs to. Lenders, government, owners, and company. So from this you remove what? Interest. So it belongs to whom? Government. Remaining partners, you give it to government. Tax. So you get PAT. That belongs to whom now? Company and the owner. Less preference dividend, now it belongs to equity shareholders and the company. Whatever belongs to company belongs to equity shareholder. So PAT less preference dividend is ETH. PAT less preference dividend is ETH, earnings available to equity shareholders. When I say PAT less preference dividend, that means if preference shares are cumulative in nature, then so there is no problem. Always you subtract preference dividend. But if preference shares are non-cumulative in nature chartered, then preference dividend should be subtracted only if it is declared. Then preference dividend should be subtracted only if it is declared. Am I clear? If it is not declared, you will not subtract. So if question when nothing is mentioned, then we'll assume it's a cumulative preference share and you will always subtract. Acha. The preference dividend in case of cumulative preference shares will always subtract preference dividend, but in case of non-cumulative preference share, we will subtract preference dividend only if it is declared. If nothing is given in the question, we assume that preference dividend is cumulative. So we will always subtract. Any transfer to reserves should be ignored. Why? Because that reserves also belongs to equity shareholders. Question remaining silent, profit given in the question is PAT. Question remaining silent, profit given in the question is always PAT. Correcta, incorrecta, correcta. Now charted. Vains. A company has 10,000 equity shares on 1190. So opening balance 10,000. Opening balance 10,000. And it issued further 5,000 shares. Issued how many? 5,000 shares. On which date? 1590. 15. So 5, 6, 7, 8, 9, 10, 11, 12. 8 months. So this 5,000 shares were there for 8 months. So into 8 by 12. 5,000 into 8 by 12 chartered comes to 5,000 into 8 divided by 12. 3,333. That is 13,333 is my vains. Oh. So opening balance will take full issued. Fresh issue you will take for the period for which it is used. It was used for 8 months, so into 8 by 12. Correct? Now, calculation of vains. Opening balance, the period is 12 by 12, so we will take for full period. Fresh issue, period is date of issue to year end. ठीक है. Buyback of equity shares you will subtract because that will decrease the number of shares. Period is equal to date of buyback to year end. Date of issue to year end, date of buyback to year end. Issue of bonus shares, you will take full 12 months. Issue of bonus shares, you will take for full 12 months. Why? Because bonus shares are issued out of reserves and surplus. Yes, reserves and surplus are carried forward from the last year. Yes, so we assume we will take it from year start to year end, since reserves and surplus are of year start. Am I clear? Yes. Issue of bonus shares in amalgamation nature of merger. Merger means continuing the business, so we will take 12 by 12. But in case of amalgamation nature of purchase, we will take the period from the date of purchase. conversion of debentures into equity shares from the date of conversion, the date when debentures got converted into equity shares, from that date we will calculate period. Interest, date of interest to year end, date of interest to year end, that is date when interest ceases to exist. Suppose if I tell you interest is on 30th June, that means interest I will pay you on 30th June. So from 30th June, so you have calculated interest in 30th June. After 30th June, interest does not exist. There is outstanding, but calculation of interest is done only till 30th June. Am I clear? So against that interest, if I have promised you, I will give you equity shares. I might give you equity shares on 1/8, but I will calculate from 30th June. Why? Because that day say interest payment had accrued. So from date of interest to year end. It is not the date when I give you shares. It is the date when I was supposed to give you shares. The last date of interest. Settlement of liability. The date when the liability accrued. The date when the liability accrued. Against services. Date on which services are rendered. Not the date on which payment was made. Date on which liability was settled. Now. Date on which liability accrued. On that date only logically I was supposed to make the payment. No? I might have paid the payment after 1 month, but I will calculate period from the day liability accrued. Purchase of asset, date of purchase of asset, कोई problem ही नहीं है. Right issue, dealt later. अच्छा. So how you will calculate period in each of the following cases is given over. Opening balance full, fresh issue from the date of issue. Buyback you will subtract from the date of buyback. Bonus you will take full year. Merger you will take full year. Amalgamation nature of purchase from the date of purchase. Conversion from the day it got converted. Interest, date of interest to year end. Settlement of liability, date when liability accrued and not liability paid. Against services, the date when services were rendered and not the payment was made. Purchase of asset, the day asset was purchased. And right issue will deal it later. Am I clear? Yes. Different denomination. Convert into equivalent number of shares. Suppose if it is given 4,000 shares of rupees 7. But normally all shares are of rupees 10. That means 4,000 into 7. How much money I'll get? 28. If this 28 I break it up into shares of 10 rupee each, then how many shares I'll get? So can I say 4,000 shares of rupees 7 or 2,800 shares of rupees 10 is one and the same? Because 4,000 shares of 7 rupees will also require investment of 28,000 and 2,800 shares of rupees 10 will also require investment of 28,000. So if the shares are of different denomination, convert them into same denomination. It can be happen like this also. 4,000 shares, or rather all 5,000 shares of rupees 12. Rest all shares are of rupees 10. Then 5,000 into 12, 60,000. In this 60,000 investment, if I wanted to buy shares of rupees 10, how many shares I would have got? So can I say 5,000 shares of 12 rupees or 6,000 shares of 10 rupees is one and the same? Yes. Oh, so number of shares into existing nominal value divided by nominal value we want. Correct? Yes, sir. Now, differential voting rights. 1,50,000 shares of equity shares class A. 20,000 equity shares eligible to receive 50% additional per share. That means these are 50% more powerful. Your 20,000 shares are 50% more powerful than me. That means plus 50% if I do, that means my 30,000 shares and your 20,000 shares are same. So class A का, class B का 20,000 shares is equal to class A ka 30,000 shares, so I will do it with 30,000 shares. Am I clear? Yes, sir. Now chartered. Bonus shares. Now, suppose chartered, ₹5 lakh, last year 4 lakh shares were there. Previous year. So how much was the EPS? 5 lakhs by 4 lakhs? ₹1.25. Current year mein also profit is 5 lakhs. But number of shares are 4 lakhs. Number of shares are 4 lakhs plus bonus issue of 1 lakh. Number of shares are 4 lakhs plus bonus issue of 1 lakh chartered. That means EPS will become ₹1. Did my profit change? No. Did my shares increase? Yes. But when the shares increase, did I get any extra resources? No. That means with same resources, I have performed the same. But if you look at EPS, no, you will believe that I have performed bad in the current year. Whatever resources I had last year, this year also I have the same resources? Yes. With same resources, I have performed the same. So have I improved? No. Have I deproved? No. But if you look at EPS, you will believe that I have deproved. Oh my God. That means why that deprovement is shown? Because of bonus share. So standard says, in case of bonus shares, people will misinterpret the results. So last year ka results should also be restated. So last year ka Hitesh by last year ka Vains plus bonus you do and recalculate EPS of last year 1. This is known as restated EPS. So that comparability becomes the same. So when you are calculating EPS with bonus shares in the current year, then you are supposed to restate the EPS of last year. How will you restate? Hitesh of last year, Vains of last year plus bonus shares. Correct, incorrect? Correct. Now. No. Right shares. Now chartered. Right shares are issued by the company. Right shares are issued by the company to its existing shareholders at concessional rate. Concessional rate means lower than the market price. Since right shares are issued at lower than market price, what happened? I generally give this example in the classroom also. My mom told me to purchase 10 pencils. 9 pencils. Because we are 3 brothers and sisters. 2 brothers, 1 sister. The mom thought each will get 3. Correct? Fair enough. Mom told don't buy any extra. I told okay. I went to the shop. The shopkeeper told me each pencil got 10 rupees. I told fair enough. But I told if I am buying 9 pencils, if I am buying 9 pencils, you should give me some discount. He told I will give you discount if you buy 10 pencils. I mean, how much discount you will give? He told 10% discount. So, 10 pencils ka price 10 rupees karke 100 rupees. 10% discount, that means 90 rupees. So I purchased 10 pencils of rupees 10, that is rupees 100 minus 10% discount. So how much? 90 rupees. Correct? I went home. Mama saw the pencils. Pencil box, there were 10 pencils. She started hitting me left, right and center. She told, I told you to buy only 9 pencils. Why did you buy 10 pencils? Mama, I bought 9 pencils only. Bola, here there are 10. I paid for 9 pencils. 1 pencil is free. Bola, how come? Bola, check the price of the box. She checked the price. Price was rupees 10. 9 pencils. I purchased for 10 rupees, that is 90 rupees. Yes. So 90 rupees I paid, 10 rupees this is a change, you gave it to me, take. And 1 pencil is free. So when, otherwise generally people say that 10 pencils I purchased for 9 rupees and got it 90. So this is concessional rate because market rate is how much? 10. You got it at how much? 9. That means you have got it at concessional rate. When you get things at concessional rate, you say no. I purchased 10 pencils at 9 rupees. I purchased 10 pencils at 9 rupees. That means how much I totally invested? 10. How much I totally invested? 90 rupees. I purchased 10 pencils at 9 rupees. That means I invested total how much? So 90 rupees. In that 90 rupees, if I would have gone at market price, how much I would have, how many pencils I could have purchased? So only 9 pencils you could have purchased. Exactly. For purchasing 10 pencils at 9 rupees, I invested 90 rupees. But with that 90 rupees, if I would have purchased at normal market price only, that is rupees 10, I could have purchased 9 pencils only. But I purchased how many pencils? 10. So can I say 9 pencils I purchased at normal market price and 1 pencil I purchased free? Yes. So right issue mein you are supposed to break this value. This ko you will treat it as fresh issue normally and this ko you will treat it as bonus shares because these are free. And since these are bonus shares, you will restate EPS of last year also. You will restate EPS of last year also. Am I clear? Now, see, total right shares issued 3000. Shares at 25. Right shares are available at what price? 25. Market price X rights. Market price X rights is how much? 30 rupees. So if I purchase the shares from the market, 3000 shares from the market, I would have got it at 30, but I invested 3000 into 25 because I am getting at 25. So how much I invested? 3000 into 25, 75,000. With that 75,000, if I would have gone into the market, how much I would have got? So with 75,000 you would have got into the market, you would have got the shares at 30 rupees only. Yes. So chartered, tell me, 3000 into 25 divided by 6. Sorry. 3000 into 25 divided by 30. 2500 shares I would have got if I would have gone to the market with the same investment. Correct? That means out of 3000 shares, paid or fresh issue is how much? And bonus issue is how much? Fresh issue, that means the shares which I would have purchased for full price, 2500, 500 is bonus. I repeat, 3000 shares company offered me at what price? 25. So 3000 at 25, that means I will invest how much? 75,000. With that 75,000, if I would have gone into the market, market would have given me shares at 30 rupees. So 75,000, market price 30 rupees. How many shares I could have purchased? 2500. So 2500 I would have purchased at full value, that is fresh issue. Extra which I purchase is free, that is 500 bonus. This will be treated as fresh issue, this will be treated as bonus. If fair value of market price is not given. Now understand. Company has 10,000 equity shares with fair value of rupees 40 come right, matlab including rights. The company offered right shares in the ratio 1:5. So chartered, number 1, your objective is to calculate X right price. Calculation of X right price chartered. How to calculate X right price? 10,000. Sorry. 5 shares if I had of 40 rupees. 5 shares if I had of 40 rupees, then they will give me 1 share at 20 rupees. If I had 5 shares of 40 rupees, then they will give me 1 share of 20 rupees. Yes. That means 5 share of 40, 200 plus 20. 220 if I invest, I will get 6 shares. But after I have 6 shares, there will be no right shares in the market. Yes, so divided by 6. So 220 rupees, I have got 6 shares. Yes, so share price of each share is how much? 220 divided by 6, 36.67. Correct? This is the price this is the price per share after the right issue, because I have purchased the rights. 5 shares of 40 if I have, then I will purchase 1 right shares of 20. Yes. So 5 shares of 40 ke liye I have invested how much? 200. 1 share ke liye I have invested how much? 20. So total investment is how much? 220. In 220, how many shares I have got? 6. So 1 share ka price is how much? 36. This is known as X right price. This is the market price after rights. Why? Because the rights are over now. Acha. Number 2. Calculation of fresh issue and bonus issue. How many shares I have? 10,000. 1/5. That means I can purchase 2,000 shares, right shares. At what price? 20 rupees. That means my investment will be how much? 40,000. I can purchase 1/5. For every 5 shares, I can purchase 1 share. Therefore, 10,000 shares I can purchase. For every 5 shares, I can purchase 1 share. Therefore, 10,000 shares I can purchase for 10,000 shares, I can purchase 2,000 shares. But at what price I can purchase? 20 rupees. So, how much will be my investment? 20,000. With that 20,000, if I go into the market, I would have got shares at 36.67. So how many shares I could have purchased? 10,000 shares. Right shares in the ratio 1:5. For every 5 shares, I can purchase 1 share. For 10,000 shares, I can purchase 2,000 shares. Those 2,000 shares I can purchase for 20 rupees. That means I have to invest 40,000. With that 40,000, if I would have gone into the market would have given me shares at 36.67. Therefore, how many shares I would have purchased? Bolo na. Sir, 40,000 divided by 36.67. 1091 shares. From market, I would have purchased only 1091 shares. That means, chartered, out of 2,000 shares, fresh issue, bonus issue. Fresh issue is 1091 and bonus issue is equal to 2000 minus 1091 is equal to 909. Wow, understood? Yes, sir. Now charted. So with this we come to right shares. Now we'll do diluted EPS. What is diluted EPS? Diluted EPS means decrease in the value of EPS. Diluted EPS means decrease in the value of EPS because of potential equity shares. Oh my God. Decreased EPS, diluted EPS means decreased EPS due to potential equity shares. But if EPS is increasing because of potential equity shares, then such EPS is known as anti-dilutive, and we are not interested in anti-dilutive. We are interested only in dilutive. That means EPS should decrease. What is potential? Potential equity shares are such instruments. Instruments means contracts. They are such contracts which will get converted into equity shares in future without any payment. They are such contracts which the company has, which will get converted into equity shares in future without any payment. For example, convertible debentures. These are contracts which will get converted into equity shares tomorrow. Convertible preference shares. They'll get converted tomorrow into equity shares without any payment. ESOP mein they will have options to get shares in future. But sir, that is a payment. Yes. But again we can say no, 10,000 ESOP at rupees 20. Market price is how much? 25. The bonus part will be how much? I can purchase how many? 10,000 minus 10,000 purchase करने के लिए how much I am investing? 20 rupees. That means I am investing 2 lakh. With this 2 lakh, I would have gone into the market. Market would have given me shares at what price? So market you would have given you shares at 25. So 4 by 5, the market would have given me only 8,000 shares. Company is giving me 10,000 shares at 20 rupees because I am employee of the company. Yes. Correct. So for buying 10,000 shares, how much I have to invest? 20 rupees. That means total 2 lakh rupees I have to invest. Yes. With that 2 lakh rupees, if I would have gone into the market, with that 2 lakh rupees, if I would have gone into the market, I would have got one share at 25. Yes. So 2 lakh divided by 25 is equal to how much? 8,000. So 8,000 shares I would have purchased by full payment. That means 2,000 shares I got free. That is bonus part. I am interested only in bonus part. Yes sir, no sir. Yes sir, I repeat. What are potential equity shareholders? Those contracts which will give rise to equity shares in future without any payment. Convertible equity shares, convertible bonus shares, convertible equity, convertible debentures, convertible preference shares and bonus part of ESOP. Now, but chartered, when you convert preference shares or debentures into equity shares, obviously number of equity shares will increase. But as soon as you convert chartered, it means you are not going to pay preference dividend, you are not going to pay debenture interest. Yes. As soon as you stop paying debenture interest or preference dividend, your profit will increase. Yes. So, DEPS, diluted EPS, is nothing but Dipesh plus increase or impact on profit due to savings in debenture interest plus preference dividend divided by Vane's plus potential equity shares. Potential equity shares means convertible preference shares, convertible debentures and bonus part of ESOP. Yes or no? Yes sir. No. Correct? Ha sir. So with that we come to end of what? Earning per share. EPS AS20. Now charted we are supposed to start with consolidation AS21, 23 and 27. Before that we take 15 minutes ka break. So we meet after 15 minutes for consolidation. Correct? Yes sir. Hello friends. Now we'll start with AS 21. That is consolidation. Now consolidation means we are supposed to basically prepare, one minute, consolidation basically means we are supposed to prepare balance sheet of holding plus subsidiary, correct? We are supposed to prepare balance sheet of holding plus subsidiary. Now this is holdings balance sheet. This is subsidiaries balance sheet. Holding has investment in equity shares of subsidiary. That is in equity shares and reserves and surplus. There is current liability. This is fixed assets. There is current assets. There is non-current liability. There is current liability. So this investment in equity shares is over here, correct? Because this investment in equity shares, you become the owner of subsidiary, you have got control over assets and liabilities of subsidiary, yes. So you remove this, you cancel this, and all assets of subsidiary and all liabilities of subsidiary will be incorporated in holdings book, yes. That means you are cancelling what? Investment in equity shares of subsidiary with equity shares plus reserves and surplus of subsidiary, yes. Equity shares plus reserves and subsidiary are known as net assets of subsidiary, correct? So you are cancelling net assets of subsidiary with investment in equity shares of holding. Investment in equity shares of holding in subsidiary, correct? You are cancelling investment in equity shares of holding in subsidiary with net assets of subsidiary. When you are cancelling, the journal entry will be equity share plus reserves and surplus, that is net assets, to investment in equity shares. Now chartered, suppose this net asset is worth 100 rupees and you have invested 100, then life is beautiful. But if this net asset is 100 and you have invested 120, that means to buy net assets of 100, you have given extra 20. Why you have given extra 20? To acquire the control. To acquire the control. That is known as cost of control, that is goodwill. But charted this 100 rupees ka net assets you acquired for 90 rupees, that means you got control at discounted price, that is your gain, that is capital reserves. Yes, no. Yes, sir. That means chartered in consolidation, CBS, step 1, you are supposed to find out holding ka share. That is 60%, 70%, when you get control, more than 50%. Now 60%, 70%, whatever percentage holding has, that remaining percentage are also the owners of the company, yes, but they do have control over the business, no. Who has control? Holding has control. Why he has control? Because holding has more than 50% of shares in subsidiary. The others which are owners of the company, which have interest in the company but do not have control, are known as minority interest, correct? So when I say this is the holdings balance sheet, this is investment in equity shares of subsidiary, this investment is in equity shares and reserves and surplus of subsidiary, that means chartered, this and this is getting cancelled because I have got control over all the assets and all the liabilities of subsidiary. Why do I have control over all the assets and liabilities of subsidiary? Because my investments are more than 60% of your equity shares. Now, understand one more thing. This is holding, this is subsidiary, yes. Investment in equity shares, yes. equity shares and reserves and surplus. Okay. Now I have got 100% investment in this, then I cancel this exactly. Yes. I have got 100% equity shares of subsidiary. That means I have got right on entire net assets of subsidiary alone. Yes or no? Then I will pass the entry net assets of subsidiary to investment in equity shares. Yes. But I have got only 70%. That means net assets of subsidiary ka I have investment worth how much? Only 70%. Remaining 30% belongs to whom? Minority interest. So when I am cancelling net assets of subsidiary, I will cancel with investment in equity shares plus minority interest. Yes or no? Yes. Correct? Yes. So chartered, first you need to find out what is holding ka this and this. Yes. Then chartered, you are supposed to find out date of acquisition. When did you acquire the control? Correct. When you are preparing CBS, you will take equity shares of holding. Ha. Reserves and surplus of holding. Ha. Minority interest. Okay. Non-current liability of holding plus subsidiary. Okay. Current liability of holding plus subsidiary. Okay. Fixed assets of holding plus subsidiary. Okay. Current assets of holding plus subsidiary. Why? Because I am cancelling investment in equity shares with equity shares and reserves and surplus. Hence, I am able to incorporate fixed assets and current liability. I cannot incorporate equity shares and reserves and surplus of subsidiary in holding. I cannot incorporate equity shares and reserves and surplus of subsidiary in holding. Why? Because they got nullified. Yes or no? Yes, sir. So equity shares of holding, reserves and surplus of holding, minority interest. Equity shares of subsidiary, reserves and surplus of subsidiary got nullified with my investment and minority interest. Yes? No? Yes, sir. Now chartered. This is known as CBS. Now chartered. Now, look at this. एकदम basics are CBS. Balance sheet as on 31st of March 90. Equity share capital 1,40,000, reserves and surplus 60 and 30, current liability 70 and 30, PP 80 and 60, investment in 80% equity shares of subsidiary. 1 minute. I'll do a good thing for you. What good thing? That I'll show you. Na 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 na. Now. So equity shares, reserves and surplus, current liability, PPE, investment in 80% equity shares on 31st of March 90. 80%. So if I am holding 80%, somebody else is holding 20%. Now charted statement of net assets of subsidiary as on 31st of March 90. This is your date of acquisition. 40,000 and 30,000. That is 70,000. Holding ka share 80%, remaining 20% minority, 56 and 14. For this 56,000, how much I am paying? 90,000. To acquire this 56,000, I am paying 90,000. So extra which I have paid, that is nothing but goodwill. Journal entry, net assets of subsidiary how much? 70. Goodwill how much? 34. Investment cancelled, minority interest cancelled. Minority interest 14,000. Consolidated balance sheet. Equity share capital of holding, reserves and surplus of holding, minority interest 14, current liability of both holding and subsidiary, non-current PP of both holding and subsidiary, goodwill which we had calculated, and current assets of holding and subsidiary. Yes sir, no sir, yes sir. Now charted. So first you learned cost of control, then you learned minority interest, correct? Now charted, there are adjustments we are supposed to learn, and the first adjustment is date of acquisition is during the year. That means charted, this is year starting, this is year ending, and somewhere in between there is date of acquisition, correct? And my objective is to calculate net assets as on date of acquisition. Yes, that means I require equity share capital and reserves and surplus both on the date of acquisition. Yes, equity share capital, whatever was there at the year starting, will be there at date of acquisition. Equity share capital will not change ever. Whatever equity share capital was there at year starting will be there at date of acquisition, will be there at year end. So equity share capital will be same on all the three dates. Why? Because if equity share capital changes, no chartered, stake would change. But the 60%, 50%, that percentage of holding will change. And that is not there in our syllabus. Sir, bonus shares, yeah, bonus shares says stake will not change. And it is there in our syllabus also. But remind you, bonus shares are issued out of reserves and surplus as on first day. Yes. So bonus share will also change the equity shares on day one. So equity share capital will increase on day one, reserves will decrease on day one only, year starting only. Just now we discussed in EPS if you remember. Yes or no? Yes sir. That means what I am trying to say is, year starting, date of acquisition and year ending mein equity share capital will remain same. It cannot change because of buyback, it cannot change because of fresh issue. It can change because of bonus share, but bonus share will also increase the number of shares on year starting and decrease reserves and surplus on year starting. Why? Because in EPS we studied that that bonus shares are issued out of reserves and surplus from the balance of last year, that is at the beginning of the year. So equity shares will increase at the beginning of the year, reserves will also decrease at the beginning of the year. So equity share capital in all the three dates will remain same. Now comes the question of reserves and surplus. Reserves and surplus opening date and closing date will not be same. Why? Because of profit earned during the period. Yes. So our objective is to find out date of acquisition ka reserves and surplus. Yes. Now suppose if I tell you, year starting ka reserves and surplus is 100, okay. Year ending ka reserves and surplus is 150, okay. Date of acquisition, that means total profit we earned is how much? 50. Up to the date of acquisition we earned a profit of 15, and after the date of acquisition we earned a profit of 35. That means profit on the date of acquisition will become 100 plus 15 is the profit on the date of acquisition. Yes or no? That profit on the date of acquisition is also known as pre-acquisition profit, because date of acquisition is Profit earned before the date of acquisition is 115. Profit earned after the date of acquisition is 35. Am I clear? I repeat. This is the date of acquisition. Year starting mein reserves and surplus is 100. Year ending mein reserves and surplus is 150. So during the year charted, we earned a profit of how much? 50. During the year charted, we earned a profit of how much? 50. This 50, if I say that before the date of acquisition, we earned 15 and after the date of acquisition, we earned 35. Therefore, profit or reserves and surplus on the date of acquisition is how much? Reserves and surplus on the date of acquisition charted is 100 plus 15, 115. And after the date of acquisition, 35. This 115 is the profit as on the date of acquisition. This profit on the date of acquisition is known as pre-acquisition profit. And the profit after the date of acquisition is how much? 35. That is known as post-acquisition profit. Am I clear? Yes or no? You understood this much? Yes. So charted, how do we calculate that? So I have created one drama. Ding dong. What is the drama? Opening balance, closing balance, current year's profit. Opening balance, closing balance, current year's profit. Suppose if I tell you opening balance is 100 rupees, closing balance is 220. That means current year's profit is how much? 120. Year starting 100, year ending 220. Therefore, current year's profit is how much? 220. Based on the date of acquisition, you calculate pre-period and post-period. Suppose if I tell you pre-period is 3 months, post-period is 9 months. Pre-period is 3 months, post-period is 9 months. Therefore, charted pre-period ka profit will be 30, post-period ka profit will be 90. Correct? That means profit up to the date of acquisition, profit after the date of acquisition, profit up to the date of acquisition, profit after the date of acquisition. This 120 you bifurcated in the ratio 3:9, 30 and 90. So, profit after the date of acquisition is how much? So, profit on the date of acquisition will become how much? So, profit on the date of acquisition will become 100 plus 30, 130, and profit after the date of acquisition 90, total profit 220. Correct? This we call it as analysis of profit. Am I clear? Yes or no? Hey, my wonderful chartered accountants. Are you understanding? Not understanding? Reply. Like, if you understand. This is like, if you don't understand. Now chartered. इधर देखो. Now chartered. Kusum, Sirvi, Rahul, understanding star. Very good, thank you. Now. Accounting year 1991. Date of acquisition 31st December. Equity share capital 1 lakh. PL balance on 1/4 is 30. PL balance on 31st March is 78. Date of acquisition is 31st of December. Now charted year starting is 1490 because year is 1991. Year starting 1490, year ending 31st of March 91. Date of acquisition is 31st December. So 14 to 31st December is 9 months. 31st December to 31st of March is post. Pre-post. Yes or no? Yes. Now I prepare analysis of profit. 1490 ka the profit is how much? 30. Year end में the profit is how much? 48. So 30 से year end में the profit is 78. 30 to 78 is how much? 48 is current year's profit. Break it between pre and post. Pre is how many months? 9 months. Post is how many months? 3 months. 30 plus 36. Date of acquisition 12 after the date of 66 plus 12, 78. Oh, now statement of net assets. Date of acquisition, equity share capital 1 lakh, year end 1 lakh. PL, date of acquisition 66, post is 12. This 166 belongs to holding and minority interest. This 12 also belongs to holding and minority interest. Am I clear? Yes. Now charted. Ready? Yes. Equity share capital 1 lakh and 60,000. ठीक है? 1 lakh, 60,000 reserves and surplus, this and this. 31st of March. H acquired 4,500 equity shares of subsidiary of nominal value 10 on 30th September 89. Okay. Now chartered 70,000, 70,000, 80, 50, 30. Out of 6,000 shares you have acquired how much? 4,500. Out of 6,000 shares if you have acquired, sir, 60,000. Na bapu. 60,000 is equity share capital. Each share is of 10 rupees. Therefore, number of shares subsidiary has is 6,000. Out of that 6,000 we have acquired is how much? 4,500. 4,500 equity shares we acquired on which date? 30th of September. Correct? Yes. Now charted, out of 6,000 if we have acquired 4,500 shares, that means 75% we have acquired. If 75% we have acquired, that means remaining 25% is minority interest. Bolo ha. If 75% we have acquired, 25% is minority interest. When did we acquire? 30th of September. The year starting 1489, year ending 31st of March 90. Date of acquisition is 30th September, 14 to 30th September. 6 months. 30th September to 31st of March, 6 months. Pre-6, post-6. Life is beautiful. Balance of reserves and surplus on 1489 is how much? 8,000. That is reserves and surplus at the beginning of the year. And reserves and surplus at the end of the year is how much? 20,000. We are doing analysis of profit of subsidiary. That is opening balance 8,000, closing balance 20,000. Yes sir, no sir? Yes sir. So analysis of profit charted. Opening balance 1489, 31st March 90, 8,000, 20,000. Current year ka profit 12,000. Pre, post 6, 6. 8 plus 6, 14, 6. Wow. So what you have written? Subsidiaries balance sheet liability. Oh, what you have written? Adjustment. Correct? Yes. Now, we have invested how much? 80. Now, adjustment 4, treatment of adjustment. Step 4, it's not there. SONA. Statement of net assets. Equity share capital. 60, 60 reserves and surplus. Opening 14. Post 6. Year end 20. This 74 में 75% is मेरा holding and 25% is minority. Post profit में my profit, minority का profit. So how much is my share in net assets? 55,500. My share in net assets is 55,500, but I have paid how much? 80. So goodwill is how much? 24,500. So step 1 में charted you will calculate percentage. Step 2 में period. Step 3 में analysis of profit. Then treatment of reserves. Then statement of net assets. Then cost of control. Then minority interest. Minority interest on the date of acquisition is 18,500. That 18,500 charted increased by 1,500. That 18,500 charted increased by 1,500. So it became how much? 20,000. That is on year end. So this is on the date of acquisition. This is on year end. Consolidated reserves and surplus. Consolidated reserves and surplus means my reserves and surplus. Who am I? Holding. Holding the reserves and surplus plus whatever share of profit I will get from subsidiary. Oh, so holding the reserves and surplus is how much? 60,000. Plus I will get from subsidiary 4,500. So my reserves and surplus become 64,500. Now charted consolidated notes to account. This is very important. Holding assets liability, subsidiary asset liability, any adjustment, then total. This total will come in CBS. ओके तो सीबीएस में शेयर होल्डर्स फंड, शेयर कैपिटल ऑफ होल्डिंग, रिजर्व्स एंड सरप्लस consolidated, minority interest, non-current liability, note number 9 is consolidated. Non-current assets, PP and intangible, PP 9, intangible goodwill, current assets. Now charted, what I am trying to say is, स्टेप्स टू सॉल्व. तो स्टेप 1 में यू कैलकुलेट स्टेक, स्टेप 2 में यू कैलकुलेट पीरियड, दैट इज period, pre and post. Step 3 में chartered you calculate analysis of profit. Step 4 में there are treatment of adjustments which we have not discussed. Then step 5 में chartered you calculate cost of control, that is goodwill or capital reserve. Correct? How to calculate cost of control? Share in net assets of subsidiary. Against the share in net assets of subsidiary, I have got investment in equity shares of subsidiary minus pre-acquisition dividend. Why? Because pre-acquisition dividend reduces cost of investment, that we studied in AS 13. Pre-acquisition dividend reduces cost of investment. So suppose this is 100, investment is 90, pre-acquisition dividend 5. Say suppose 120, pre-acquisition dividend is 5, that means investment is 115. That means chartered against my share of net assets 100, my share of net assets, share in net assets, not total net assets, my share of net assets is 100, against that I have invested 115. So how much extra I have invested? 15, that is goodwill. Investment in equity shares of subsidiary minus pre-acquisition. Then chartered we calculate minority interest, that is minority interest as on date of acquisition. Minority interest as on the date of acquisition is nothing but MI's share in net assets of subsidiary. This is holdings share in net asset of subsidiary, this is MI's share in net assets of subsidiary, plus share of post profit of MI, minority interest. That will give you MI as on year end. Oh, then chartered number 7 में you calculate consolidated reserves and surplus. This is basically representing holdings, reserves and surplus. Consolidated reserves and surplus basically represents holding, reserves and surplus. That is reserves and surplus of holding plus share of post profit. Correct? No, number 5 is SONA, statement of net assets. Statement of net assets मतलब date of acquisition, post year end. Statement of net assets of subsidiary, equity share capital, both will be same. Reserves and surplus, This reserves and surplus, I'll get it from AOP. So that will give me net assets as on the date of acquisition. Holding and MI I will distribute. Post also I will distribute between holding and MI. Correct? Then I'll prepare cost of control, minority interest, reserves and surplus. Consolidated notes to accounts. Then consolidated balance sheet. Correct? Yes. Now, so we have got how many steps? 10. First is stake. Second, period. Third, analysis of profit. Fourth, statement of net assets. Correcta, incorrecta? Now, इधर देखो. Now we will understand every adjustment. Step 1, stake. Step 2, period. Step 3, analysis of profit. Step 4, treatment of adjustment. Step 5, SONA. Step 6, cost of control. 7, minority interest. 8, consolidated reserves and surplus. 9, consolidated notes to accounts. 10, consolidated balance sheet. Oh my. Now, charted, we have understood everything except treatment of adjustments. First adjustment is fictitious asset. Which asset? Fictitious asset. First of all, fictitious assets should not appear in balance sheet. If fictitious assets are appearing chartered in balance sheet, if fictitious assets are appearing in balance sheet of holding, then less from consolidated reserves and surplus. If fictitious assets are appearing in subsidiaries balance sheet, less from date of acquisition wala profit. 1 minute, chartered, give me 1 minute, I'll be back. Now chatter. Now we are supposed to start discussions of treatment of adjustments in consolidation. A very, very important point to be noticed. Any adjustment, if it impacts profit, check whose profit is it impacting. Holding ka profit or subsidiary ka profit. If any adjustment impacts holdings profit, then you adjust in CRS, consolidated reserves and surplus. But any adjustment impacts subsidiary ka profit, then adjust in statement of net assets. Then check whether it is impacting pre-profit or post-profit. If it is impacting pre-profit of subsidiary, then it will impact profit on date of acquisition. If it is impacting post-profit, then it is post-profit only. I hope the things are clear. Check whether any adjustment impacts profit or not. Then check whose profit. If it is impacting holdings profit, then adjust that in consolidated reserves and surplus. If it is impacting subsidiaries profit, adjust that in SONA. If it is impacting subsidiaries pre-profit, then adjust SONA on the date of acquisition. If it is impacting subsidiaries post-profit, then adjust in post-period. Am I clear? Yes. Now fictitious asset. Fictitious asset, you see it in the balance sheet on date of acquisition. That means fictitious asset were there in the balance sheet before the date of acquisition. If you can see fictitious asset in the balance sheet as on the date of acquisition, that means they were existing from before the date of acquisition. Yes. Fictitious asset should not appear in balance sheet, it should be written off against P&L. Yes, no, yes. So, if chartered fictitious asset is appearing in the balance sheet, it should be reduced from profit. Yes. If it is appearing in holdings balance sheet, it should be reduced from holdings profit. Yes. Holding a profit means consolidated reserves and surplus chartered. Holding a profit means consolidated reserves and surplus chartered. Yes or no? Yes. But if it is in subsidiaries balance sheet, then you are supposed to reduce it from profit on date of acquisition. Then you are supposed to reduce it from profit on date of acquisition in SONA. Acha. This is fictitious asset. Adjustment number 2, contra item. You can call it mutual owings, you can call it intercompany debt. That means holding and subsidiary are debtor and creditor of each other. Holding and subsidiary are debtor and creditor of each other. Then the journal entry is creditors to debtors. If these items do not match, then we say difference is goods in transit or cash in transit. Oh, yes, that means goods sent but not reached, goods sent by holding but not reached subsidiary, or cash sent by subsidiary not reached holding. So, goods or cash sent by one not reached another. Nothing is mentioned, you will assume cash in transit. Okay. Now charted, or it can be bills payable to bills receivable. Bills payable to bills receivable. Now charted, one person is saying bills payable is 100, but another person is saying no, bills receivable is 80 only. I am saying I have accepted bills on you for 100 rupees. You are saying no, I have got only 80 rupees. Why? Because 20 rupees we have got discounted. So bills payable to bills receivable, when you set off, which figure you will set off? You will set off actual contra item or bills receivable, whichever is lower. Actual contra bill is 100 rupees, but bills receivable is 80. So you will set off 80 only. Why? Because 20 is discounted. Am I clear? So actual contra item or bills receivable, whichever is lower. Oh, correct. Yes. Number 3. Adjustment number 3. Unrealized profit. Unrealized profit on stock. It can be any other asset. Any asset. There is company A. There is company B. Company A sold 100 rupees का stock to company B at 120. Company A sold 100 rupees का stock to company B at 120. So company A made a profit of 20 rupees. Company B की balance sheet में this asset is appearing at 120. Company B की balance sheet में it is appearing at 120. Company A plus B chartered are group companies. Company A plus B are group companies. That means one is holding, another is parent. Now, after they merge, they have to show this stock at 120 or 100. Sir, after they merge, they should show this stock at 100. So B का stock should reduce by 20. Yes. Correct. A has booked a profit of how much? 20. A has booked a profit of 20. That means they are supposed to remove profit by 20. Yes. So profit, A's profit should reduce by 20. B's stock should reduce by 20. Yes. Who is A? Sir, A is a supplier. Who is B? B is a receiver. So can I say it should be suppliers or rather sellers PL to buyers, sellers PL to buyers stock, sellers PL to buyers stock, how much? 2020. Yes. Now charted, when I say sellers PL to buyers stock, this stock will reduce in CBS. But who is the seller? Seller can be holding, seller can be subsidiary. Yes. If seller is holding, less from CRS, because holding a profit should get impacted in CRS. If seller is subsidiary, then less from Sona. But Sona may pre or post. When I said they are group companies, that means they are into relationship of holding and subsidiary. Yes. Then only this drama will happen. No. Yes. Before getting into holding subsidiary ka relation, can he sell at a profit? Yes. Allowed, disallowed, allowed. This is disallowed only they get into relation. When they did not get into relation of holding and subsidiary, can one company sell goods to another company at profit? Yes. Now charted. Now charted. So 100 rupees ka goods sold at 120. Yes. Unrealized profit is after the date of relation, before the date of relation. Sir, after the date of relation, before the date of relation, this profit is allowed. That means this is after the date of relation, so it should be subtracted from post. So unrealized profit on stock transacted ka journal entry is seller's PL to buyer's stock. Seller, if it is holding, then reduce from CRS. Seller, if it is subsidiary, reduce from post profit. And balance sheet say you will reduce stock. Correct? Yes, sir. 3 done? Yes. Now charted. Now, adjustment number 4. Adjustment number 4. is dividend. Dividend declared or proposed. Dividend declared or proposed by holding or subsidiary, ignore. Why? Because chartered, suppose this is year end, 31st of March, this is current year, this is next year, previous year, 31st of March. I am preparing CBS on this date. So I have got holding ka balance sheet as on this date and I have got subsidiary ka balance sheet as on this date. Now chartered, current year ka dividend will be declared and paid in the next year? Yes. So am I interested? No. Previous year ka dividend is paid and declared in current year? Yes. If it is declared in current year, any problem? No. This is paid and declared in current year before 31st of March? Yes. So chartered, whatever balance sheet you are saying that is after impact of dividend? Yes. So am I supposed to do anything? No. I repeat. Current year ka dividend will be declared and paid in the next year. I am not interested. Previous year ka dividend declared and paid in current year. I am interested. But current year ka balance sheet, dividend is before, balance sheet is later on. So balance sheet is prepared after giving impact of dividend. So whatever accounting for dividend was supposed to be done, that is already done. So dividend declared or proposed, ignore. Now chartered, if sub C declared, and paid previous year's dividend in current year, तो प्रॉब्लम क्या होता है? अकाउंटिंग इज ऑलरेडी डन, बट चार्टर्ड अंडरस्टैंड व्हाट आई एम ट्राइंग टू से. सपोज शेयर कैपिटल of subsidiary is 4 lakhs. Share capital of subsidiary is 4 lakhs. Rate of dividend is 20%. That means amount of dividend is how much? 80,000. Yes. Now chartered, opening balance of profit is, suppose they have given 4 lakhs. Closing balance of profit they have given is 6 lakhs. Therefore, current year's profit is how much? 2 lakhs. And if I tell you pre and post is 6 months, 6 months. My question is, this dividend is declared by subsidiary. This is year starting. This is year ending. Year starting ka profit is how much? 4 lakhs. Year ending ka profit is how much? 6 lakhs. This dividend is declared over year. If this dividend is declared and paid over year, that is 80,000 ka dividend is declared and paid over year chartered, that means this 6 lakhs is after dividend, before dividend? After dividend. Accounting is done, not done? Done. Very good. This explanation most of the people forget when I move ahead in life. Please don't forget that dividend is declared, dividend is accounted. So closing balance of profit is after dividend. Always remember chartered, closing balance of profit is after dividend. Most of the people forget this line. They remember the treatment, and in few sums, if you remember the treatment only and forget this line, you will have a problem. Sir, what is the line, sir? Once again say, sir, please. Closing balance of profit is after the dividend. Closing balance of profit is after dividend. Okay. Now chartered. Ready? Yes. So what do we do? Opening balance 4 lakhs, closing balance 6 lakhs. This 6 lakhs is after profit. Therefore, current year ka profit 2 lakh, pre-profit 1 lakh, post-profit 1 lakh. That means chartered, my pre-profit is 5 lakhs, post-profit is 1 lakh. But now let's understand what would have happened. This 6 lakhs is after dividend of 80,000. So current year's PL, statement of PL, that is prepared in Excel. So how it looks? It looks opening balance 4 lakhs. Current year's profit, I don't know. Sir, you know current year's profit 2 lakhs. That I have come to know from here. Over here I don't know current year's profit. No. Then chartered I'll get total profit. Total profit may say less. Dividend. How much dividend? 80,000 dividend. After you subtract 80,000 dividend, you should get closing balance. Closing balance is how much? So 6 lakhs is after dividend of 80? Yes. If it is after dividend of 80, this should be 6 lakhs 80? Yes. If this should be 6 lakhs 80, then current year ka profit is how much? So 2 lakhs 80. Yo. And how much profit you got? 2 lakh. Oh my God. Shit. That means this 80 logically, how did you get this 6 lakhs? Opening balance 4 lakhs. Closing current year ka profit 280. You paid dividend of 80. That dividend of 80 should be subtracted from opening balance. Yes. So it should come to 320. But you by mistake subtracted from this 80 and got 2 lakh. Oh, so you should have subtracted from opening balance, but you have subtracted from current year's profit. So what is the logical thing to do? Logical thing to do is A. First calculate the amount of dividend 80,000. Yes. Second logical thing is chartered opening balance 4 lakhs. Closing balance 6 lakhs. Again I tell you, is closing balance after dividend? Yes. Dividend is how much? 80. 80 should have been paid from where? Opening balance. Opening balance is how much? 4 lakh means 80 dividend paid. So this becomes how much? 320. 320 is 6 lakhs. Current year's profit is how much? 280. Now bifurcate. Pre and post. So I have got two advices. Advice number 1. Again I am shouting that same sentence, probably for the 5th time, that closing balance is after dividend. Dividend is already accounted. I am not accounting for dividend. But if I follow this, I land up calculating wrong pre and post profit. Hence, to calculate correct pre and post profit, I subtract dividend from opening balance. Opening balance, and then I calculate pre-profit and post-profit. Am I clear? So, am I doing accounting or mathematics to find out correct pre-profit and post-profit? Beta, I am not doing any accounting. Remember, I am not doing any accounting. I am just doing mathematics to find out correct pre-profit and post-profit. And again, I repeat that sentence. My closing balance is after declaration of dividend. Dividend has been accounted. Yes or no? Different question, just explain, sir. Vishal, what you wrote, that is a different question, and just explain, sir. No need to solve. Not able to understand illustration 5 of consolidation. Illustration 5, this one, Vishal, sir, 9 steps of consolidation. Please explain how to adjust bonus entry in balance. Relax. I am doing all the adjustments, Vishal. I will come to bonus. Till now, I have discussed 2-3 adjustments only. That much you understood. Reply fast. Rahul, you understood dividend. Fatafat reply. Bonus I will come, Vishal. Rest everything you understood, and Rahul, please reply. Now, so in case of dividend, point number A, calculate A, amount of dividend. This is amount of dividend of last year or current year? Last year, because last year's dividend is declared and paid in current year. How to calculate amount of dividend? Dividend, Vishal, I did not get your reply. Dividend percentage into share capital of subsidiary. Dividend percentage into share capital of subsidiary. Then, analysis of profit. Opening, closing, current year's profit. Closing profit, opening profit. This opening profit may say amount of dividend you will subtract. Whatever you get, that and closing balance say you will get difference, you will get it at current year's profit. Yes? No? Yes, sir. Now, bonus shares, Vishal, I will explain 9 steps of consolidation that you understood or not. 10 steps rather. Now, this closing balance is after adjustment of dividend. Why I am shouting that, I will again explain. One thing I have to tell you. Now charted, this dividend is pre-acquisition dividend for holding. Yes. So holding should credit this dividend to investment. Yes. But if holding has credited by mistake to PL, then holding should credit this dividend to investment. If holding has credited this dividend to PL by mistake, then holding will pass the entry HSPL to investment. That means less from consolidated reserves and surplus and less from investment in COC, cost of control. Correct entry should have been bank to investment. होल्डिंग का अकाउंटेंट ने पागलपन किया. होल्डिंग का अकाउंटेंट पास द एंट्री बैंक टू PL. I told, nah Baba, nah, this is wrong, so rectify. PL to reverse of wrong entry, PL to bank. So entry should be PL to investment. They wrongly credited PL, they should have credited investment. Correct? Now charted, why am I telling this? Suppose balance sheet is on 31st December 90. This is interesting. Balance sheet is on 31st December 90. On this date, PL given in the balance sheet is say 4 lakhs. Now chartered date of acquisition is 31st December 90. Correct? Yes. Dividend paid, it's a suppose 80,000 by subsidiary in 90. My question is, will you subtract this dividend from 4 lakhs? No. Is it pre-acquisition dividend? Dividend paid rupees 80,000 by subsidiary Is this pre-acquisition dividend? Yes. Will you subtract this from 4 lakh? No. Why? Closing balance is always after dividend. So you will not do this drama only. Why? Because this 4 lakhs is after 80,000 only. This is closing balance. And date of acquisition is also closing. So no drama. Oh, but that entry HSPL to investment you will pass. That is 80,000 into say holding ka share is 80%, that is 60. 4,000, that entry you will pass. Correct? Yes sir, no sir. Bol Rahul, understood that if date of acquisition is on year end, this is also on year end, then dividend you will not subtract it from closing balance. Why? Because closing balance is already after subtracting dividend. But this entry you will pass, analysis of profit you will not prepare only. Why? Because date of acquisition is year end. If date of acquisition is during the year, then only you need to prepare analysis of profit. Yes sir, no sir. Yes sir. So till now how many adjustments we have discussed? Number 1, fictitious assets. Number 2, contra item. Number 3, unrealized profit. Number 4, dividend. Dividend, if dividend is proposed or declared, no entry. If dividend is declared and declared and paid by subsidiary, last year's dividend is paid in current year, then you will calculate the amount of dividend, analysis of profit, we will subtract it from opening balance. And if holding has wrongly credited to PL, then you will pass the entry PL to investment. Now, and one more line I told, that if date of acquisition is year end, do not subtract dividend from closing balance. Why? If date of acquisition is year end, then do not subtract dividend from closing balance. Why? Because it is already subtracted. Number 5, revaluation of PPE. Revaluation of PPE. Revaluation of PPE of subsidiary on date of acquisition by holding. Revaluation of PPE of subsidiary on the date of acquisition by parent. So this is not for standalone, this is only for CBS. Now understand chartered. This is year starting. This is date of acquisition. This is year ending, and this date you are supposed to prepare CBS. Correct? This date you are supposed to prepare CBS. Balance sheet of subsidiary as on this date is given. You are supposed to find out revaluation gain or loss on the date of acquisition, because revaluation happens of subsidiary's fixed asset on the date of acquisition. Correct? How will you find out that? Book value on the date of acquisition, fair value on the date of acquisition, the difference will give you gain or loss. Fair value will be given in the question. I have to find out book value. How do I find out book value? Book value on year starting minus pre-period ka depreciation. बुक वैल्यू ऑन ईयर स्टार्टिंग माइनस प्री पीरियड का डेप्रिसिएशन. Compare, you get gain or loss. That gain or loss, if it is gain, then PPE will increase to SS pre-profit. Why? Because this is related to pre-period. If there is loss, SS pre-profit to PPE. Correct or incorrect? Correct. So as soon as you book gain or loss, fair value will come into play. Now charted, this is post period. Post period mein charted, they would have charged depreciation on book value, but we should charge on fair value. So then we'll say depreciation charged. Depreciation charged. Book value into depreciation percentage into post period. Depreciation chargeable is fair value into depreciation percentage into pre-period. The difference is either there is extra depreciation, additional depreciation, or saving in depreciation. If there is additional depreciation, asset will decrease. SS post profit to PP. Post profit, why? Because this is related to post period. Or savings in depreciation, you will save depreciation. If you save depreciation, asset will also increase, profit will also increase. Then PPE to SS post profit. Oh, so make a line like this. You want book value as on the year starting, book value on year starting minus depreciation for pre-period will give you book value as on the date of acquisition. Fair value on the date of acquisition, you will find out gain or loss, pass the journal entry. Correct? Then depreciation for post period, they would have charged on book value, you should have charged on fair value. The difference may either you have to charge additional depreciation or you will save in depreciation. But charted book value say from year to year you are supposed to charge depreciation. The depreciation percentage should be given. If it is given, very good. Otherwise, suppose if I tell you book value over here is 135, book value over here is 150. That means 150 say 135, that means depreciation is how much? 15 rupees. 15 rupees is the depreciation on 150, yes. That means what is the depreciation percentage? 15 by 150 into 100. That is 10% chartered. Yes or no? Yes, sir. Now. See. Revaluation. First you calculate depreciation percentage, then calculation of book value, revaluation gain or loss, that is book value on the date of acquisition, fair value on the date of acquisition. Savings in depreciation. Why? Because there is asset is decreasing, so you will save depreciation in post period. Charged, chargeable. Yes sir, no sir. Yes sir. Now, so my wonderful chartered accountant, so we have studied revaluation also. So first is fictitious asset. Second, contra item. Third is unrealized profit. Fourth is revaluation. Fifth, dividend. Correct? Now, sixth. Fifth, dividend we have already done. Sixth, preference shares of subsidiary not held by holding is transferred to MI. Please don't forget this. Preference shares of subsidiary. If subsidiary does not have preference shares, life is beautiful. If there is preference share capital of subsidiary and if it is held by holding, then it will become part of cost of control and everything. Preference shares of subsidiary If it is held by holding, held by minority interest. Held by holding will be part of investment, go to cost of control, part of investments. Correct? Yes. But if it is not held by holding, then it will go to minority interest. Preference shares of subsidiary not held by holding will be transferred to minority interest. Am I clear? Yes. Now this is summary of all the adjustments which we have done, chartered. 7 adjustments we have done. Uska summary. Fictitious asset less from CRS, consolidated reserves and surplus, less from pre-profit of SS Sona. This is fictitious asset. Contra item, creditors to debtors difference is goods in transit. If it is creditors to debtors, then the difference is goods in transit. If it is bills payable to bills receivable, then actual bill accepted or bills receivable, whichever is lower. Actual bill accepted or bills receivable, whichever is lower. Unrealized profit, seller's PL to buyer stock. If seller is holding, less from CRS. If seller is subsidiary, less from post profit. Why? Because this transaction took place after they came into relation. Revaluation, this we have done. If depreciation is not given, first calculate depreciation, then revaluation gain or loss, then additional savings and depreciation. If depreciation is given but book value at year starting is not given, then book value at year ending, then book value, suppose year starting में it is 150, depreciation is 10%, sorry, year ending का book value is 216, depreciation is 10%, year starting का book value is not given, then how will you calculate? 216 is after 10% depreciation, that is 90%, divided by 90%, 240. Correct? Yes. Now, dividend, amount of dividend by S, reduce the amount of dividend from opening balance in AOP. From opening balance in AOP. If H has wrongly credited it, then share of dividend to, then share of, if H has wrongly credited its share of dividend to PL, then HSPL to investment. HSPL to investment. HSPL is CRS. Reduce it from cost of control. Preference shares held by holding, part of investment in cost of control. Not held by holding, add to minority interest. Understood? Yes or no? Yes, sir. But dividend, if dividend, no sorry, if date of acquisition is on year end, then A, do not deduct dividend from closing balance, and B, do not deduct dividend from closing balance. That is first point. And HSPL to investment, this entry you pass. Correct? Yes. So these, and last charted is bonus shares. Bonus shares by holding. Ignore. Why? Because holding the balance sheet means impact is already given. Bonus shares given by subsidiary. and it is accounted by subsidiary. What is the journal entry for bonus share? Reserves to share capital. Bonus is given by subsidiary, accounting has been done by subsidiary. Some cases it will be stated not accounted by subsidiary. If nothing is mentioned, you will follow this. Accounted by subsidiary. This you will follow only if question specifies. Which illustration 5 Vishal you are talking? When I asked you, you did not tell the illustration 5 which I have done. One minute. One minute. Oh, variety limited, that I have done in the class only. ये रहा. Variety limited I have done in the class. ये रहा variety limited. This I have done in the class only, Vishal. This is the solution also. That I have done in the class. If you go through, you will get it. Not to worry. Now I will explain after I finish this part. Bonus shares. Accounted by subsidiary, not accounted by subsidiary. Nothing is mentioned, we assume it is accounted, and if question specified it is not accounted, then only it is not accounted. Now chartered. Now accounted by subsidiary. Then you will do A. Calculate amount of bonus and subtract from opening balance of PL or GR, opening balance of PL or GR in AOP. Calculate amount of bonus and subtract it from opening balance of PL and GR in analysis of profit. Life is simple. Yes. correct, not accounted, then what will you do? A, calculate amount of bonus. B, add to share capital and add to share capital in date of acquisition in Sona less date of acquisition, always add it to opening balance only, less from general reserve in Sona, date of acquisition or post as the case may be. As the case may be. If nothing is mentioned, we'll subtract it from date of acquisition only. Date of acquisition ka add to share capital, date of acquisition ka subtract from share capital, reserves. Because the journal entry is what? Reserves to share capital. So reserves will decrease chartered on the date of acquisition. Share capital will increase chartered on the date of acquisition. But if the question says subtract it from post reserves, then you will subtract it from post. But again, I repeatedly tell you, always add to share capital on the date of acquisition. Why? Because share capital will always increase on the date of acquisition. Otherwise, stake will change, which is not there in your syllabus. Acha, if accounting is not done, we'll pass the entry reserves to share capital. Share capital will add back on the date of acquisition. Reserves will subtract on the date of acquisition. But if the question says post, then we'll subtract it from post. Yes. Am I clear? Yes or no? Yes, sir. Now chartered bonus. Bonus. Na 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 na. This is bonus के पहले. So bonus में sub C has accounted for bonus share. Reduce the amount of bonus from G or PL's opening balance in analysis of profit. Subsidiary has not accounted. Reserves to equity share capital less from reserves in Sona. Add to equity share capital in Sona on date of acquisition, irrespective of date of bonus issue. Correct? Yes. And how to calculate stake? Ratio of bonus, equity shares before bonus, bonus after bonus. Subsidiary का equity shares before bonus, bonus shares after bonus. Holdings investment in equity shares before bonus, bonus and after bonus. You compare these two and find out the stake percentage. Both should be after bonus or both should be before bonus. I have taken both should be after bonus. That means subsidiary का equity share capital should be after bonus and holding का investment should also be after bonus. Subsidiary का number of shares should also be after bonus. Holding का investment in equity shares should also be after bonus chartered. Am I clear? Yes or no? Yes, sir. Achha. Now chartered, it is written in the question, no entry has been made in the books of holding. Holding is receiver of bonus. The receiver of bonus never passes any journal entry only. So don't get confused by this line. No entry has been passed in the books of holding. Baba, holding never passes entry only. No entry should be passed since bonus are free shares. Oh, correct? Yes. Now chartered, listen to this question. CPL, consolidated profit and loss. Consolidated profit and loss. Consolidated profit and loss is prepared with all income and all expenses of both holding and subsidiary. ठीक है? It is prepared only up to PBT, profit before tax. Holding का income plus subsidiary का income माइनस इंटरकंपनी ट्रांजैक्शन, होल्डिंग का एक्सपेंस प्लस सब्सिडरी का एक्सपेंस माइनस इंटरकंपनी ट्रांजैक्शन, इनकम और एक्सपेंस ऑफ होल्डिंग प्लस इनकम और एक्सपेंस ऑफ सब्सिडरी माइनस इंटरग्रुप ट्रांजैक्शन. फॉर एग्जाम्पल, परचेज ऑफ होल्डिंग 500, सेल्स ऑफ होल्डिंग 300, sales of holding, sales of subsidiary, purchase of holding, purchase of subsidiary, sales of holding, sales of H sold goods of 72S at 100 rupees. तो होल्डिंग सोल्ड, तो होल्डिंग के सेल्स में इट इज इंक्लूडेड एंड सब्सिडरी के परचेज में इट इज इंक्लूडेड. सो दिस शुड बी सब्ट्रैक्टेड फ्रॉम परचेज ऑल्सो, सेल ऑल्सो. दिस इज वेरी इंपॉर्टेंट. When I gave expense, for me it is an expense, for you it is income. So it should be subtracted from income also, it should be subtracted from expense also. Holding sold goods to subsidiary, that means holding के लिए it was income, हाँ, subsidiary के लिए it was expense, yes. So it should be subtracted from income, sales, yeah. It should be subtracted from expense, purchase, yes. Suppose subsidiary gave rent to holding, subsidiary gave rent to holding, then subsidiary के लिए it is expense, holding के लिए it is income. Sir, CPL is important. CPL is very, very, very important this time. Why? Because it has not come from past 3-4 attempts. So it has become very important. 14 marks का consolidation sure shot है. Correct? Oh. Then charted. Unrealized profit should always be treated as an expense. So changes in stock plus unrealized profit. So you write now changes in inventory. Over there you write opening stock minus closing stock plus unrealized profit, and that will give you total changes in stock. Unrealized profit should always be treated as an expense. Unrealized profit, it reduces profit, therefore it should always be treated as an expense. Correct? Yes. Now charted वो variety वाला question. No. Please go through whatever we have done in the class. It is very, very important. Now, variety holds 46. Variety holds 46% of paid up share capital of VR Limited. ठीक है. The shares were acquired at a market price of 17. ठीक है. The balance of shares of VR Limited are held by foreign collaborating company. That is also okay. A memorandum of understanding has been entered into with foreign company providing for the following. The shares held, so there is a company called VR Limited. That VR Limited का 46% shares are held by Variety and remaining 54% shares are held by foreign collaborating company. So there is a company called VR Limited. We are Variety. We are holding 46, foreign company is holding 54. So basically today foreign company is a holding company, we are minority interest. The shares held by foreign company will be sold to Variety. So they are holding how many shares? 54%. That we will buy it. So we already have 46 plus we will buy 54. So we will become 100% shareholder. Am I clear? Now, no, May 25 में PL नहीं था ना बेटा. The shares held by foreign company will be sold to Variety. The price per share will be calculated by capitalizing yield at 15%. Now, this is the entire sum ka crux over here. The shares held by foreign company will be sold to Variety Limited. The price per share will be calculated by capitalizing the yield at 15%. Capitalizing the yield. Now charted, what is yield? Understand. Yield means profit. So yield by 15% will give you value of total share capital. Yield by 15% will give you value of total share capital. This if you divided by number of equity shares, it will give you price of each equity shares. Am I clear? See, the shares held by foreign company will be sold to variety. At what price? The price per share will be calculated by capitalizing the yield at 15%. Capitalizing the yield at 50% means yield by 15%. If you divide by percentage, it is not capitalization. If you multiply it by percentage, it is called return. Capital into percentage will give you return or yield. But capital is equal to return by yield percentage. This is known as capitalization. So capitalization is nothing but yield by return percentage. Yield for this purpose would mean 40% of the average pre-tax profit of last 3 years, 30 lakhs, 40 lakhs and 65 lakhs. Acha. Now ignore for time being B and C and come down to the last paragraph. The above agreement was approved by all concerned for giving effect to an 1/4/2001. The total assets of VR was 100 lakhs. It was decided to write down property, plant and equipment by 175. Current liabilities of VR as on the same date were 20 lakh. The paid up share capital was 20 lakhs divided into 2 lakh shares. So chartered VR has how many shares? 2 lakh shares, out of which 46%, that is 92,000 shares we already had. Remaining 1 lakh 8 shares were with whom? Foreign collaborating company which we are supposed to purchase. Yes. Find out goodwill or capital reserve. Now chartered. Average pre-tax profit 30, 40, 65 divided by 3 is 45 lakhs. Yield is equal to 40% of 45 lakhs. Yield is equal to 40% of average pre-tax profit of last 3 years. Last 3 years ka average pre-tax profit is 30, 40 and 65. The average is 45. Yield is equal to 40% of 45, 18. Yes. Total capital value is yield by 15%. Yes. Again I will tell you, listen to this. What is yield? Average profit into 40%. What is average profit? 45 lakhs into 40%. Therefore, yield is equal to 18 lakhs. Therefore, capital is equal to 18 lakhs divided by 15%. That is 120 lakhs. Number of shares 2 lakhs. Therefore, each share ka price rupees 60. That means foreign collaborating company will sell each share at rupees 60. How many shares he will sell? 1,08,000 shares. Oh my God. Now, total capital value 18 lakhs by 15%, 120 lakhs. Therefore, price per share 120 lakhs by 2 lakhs 60. Statement of net assets of subsidiary. Assets 100 minus assets are decreasing by 1.75 lakhs. See, assets were 100 lakhs. Write down property, plant and equipment by 175. So, asset minus 1.75 less liability is equal to net assets. And holding, now we will have entire 100%, that is 78,25,000. My objective is to calculate goodwill or capital reserve. H is a share in net assets 7825, cost of investment. Total how many shares subsidiary has? Total how many shares subsidiary has? 2 lakh. First I purchased how much? 46%. At what price? 17. Then I purchased how many shares? 54. At what price? 60. So initially I paid 1564, then I paid 6480, therefore total I paid 8044. Therefore goodwill is equal to, I paid more, 2,19,000. Yes sir, no sir. Cost of control, net assets is 78,25,000. H is a share in net assets of subsidiary 7825. Subsidiary ka total share is 2 lakh, of which we purchase initial 46%, that is 92,000 at 17 rupees. Then we purchase remaining 54% at 60 rupees. That 60 rupees we calculated here. So 2 lakh ka 54% is 1,08,000 shares we purchase at 60 rupees, that is 64 lakh 80. करेक्ट विशाल, ब्लड प्रेशर बढ़ा दिया था तुम मेरा। अंडरस्टूड, यस और नो? So question was very simple. 2 lakh equity shares, we had 46%, remaining 54%. 46% is 92,000, which we purchased for 70. 1,08,000 shares we purchased for what price? That we had to find out. They are saying value price is equal to yield by 15% divided by 2 lakh shares. Yield is average profit into 40%. The average profit is how much? 45 lakhs into 40% divided by 15% divided by 2 lakhs. 45 lakhs into 40% is 18 lakhs. 18 lakhs divided by 15% is equal to 120 lakhs divided by 2 lakhs. Therefore, price per share is 60. Therefore, 54%, that is 1,08,000 shares I purchased for 60. So, A plus B is my total investment. A plus B is my total investment. Correct? विशाल गायब हो गया. Is my total investment. Net assets is equal to assets minus liabilities. Assets is 100 lakhs, which has gone down by 1.75 lakhs, minus liability 20 lakh. Net assets and investment, if you compare, you will get goodwill. Yes sir, no sir? Yes sir. So assets minus liability is net assets. Our share is 100%. Cost of investment, 92,000 shares at 17, 1,08,000 shares at 60. This is the total price paid, goodwill. Very good. Now chartered, we are done with consolidation. We meet after 15 minutes for associate and joint venture. Correct? Yes sir, no sir? Yes sir. Now, age 21. Associate. Associate means chartered. Associate means then invest. There is company A. There is company B. Company A has taken more than 20% equity shares of company B. Company A has taken more than 20% equity shares of company B, but less than 50%, less than equal to 50%. Then company A is known as investor, company B is known as associate. Am I clear? Yes, sir. In such cases, age 23 states you are supposed to apply equity method of consolidation. Equity method of consolidation में you will prepare CBS, yes. You will write equity share capital of investor, reserves and surplus investor, liabilities investor, assets investor. Only one item you will write extra, that is investment in equity shares of associate. That is share in net assets plus goodwill. Oh, share in net assets plus goodwill. Yes. Correct. So chartered. Now, understood this much? Yes, sir. So in consolidated balance sheet, associate ka only one item comes, that is investment in equity shares of associate. That value is nothing but share in net assets plus goodwill. Correct? Now chartered, when investor company purchases equity shares in associate, then in standalone financial statements are as follows. Investment in equity shares of associates, yes. Investment in equity shares of associates, yes. Less pre-dividend, okay. Other income, dividend received out of post-acquisition profit. Because whatever dividend is received out of pre-acquisition, subtracted post-acquisition will come in. This is standalone financial statement of whom? Investor. So I am invested in associates I get dividend. That dividend can be pre, that dividend can be post. If that dividend is pre, I will subtract it from my investment. If that dividend is post, I will transfer it to my P&L account. Am I clear? Yes, no, yes, sir. Now chartered. Steps to solve the problem. Steps to solve the problem. Chartered step 1. SONA. Step 1, SONA. Statement of net assets, same as discussed in consolidation. Step 2, calculation of goodwill or capital reserve, same. Calculation of carrying amount of investment in associate for CBS as per AS 23. Share of net assets that would have calculated earlier. Add goodwill. That will give you cost of investment. Add share of post profit less dividend received. That means, now chartered, when I invest, I have investment of 100 rupees plus my share of post profit is 20. So how much I am supposed to receive from my associate? 120. 100 I have invested, that I want back, plus share of post profit 20 I want back. Out of this 120, they give us back 5 rupees as dividend. So I will subtract 5 rupees and I will say I still want 115. So this is the amount I invested. This is my share of profits. I want 120. Out of that 120, you have already given away to me as dividend, that I will subtract. So I am still supposed to receive 115. Yes, sir. No, sir. Yes, sir. Now, this can never be negative. Consolidated balance sheet. This alpha will come here. Consolidated PL, other income, share of post profit, dividend received. Share of, this is CPL, share of post profit is 300, out of which I would have received a dividend of say 60. That dividend I transfer it to investment here. This part is just a disclosure chartered. This part is just a disclosure. Am I clear? So, if I tell you, that means in standalone, balance sheet you will write investment less pre-dividend, and PL I will write dividend received, that is post dividend. So pre-dividend I will subtract it from investment, post dividend I will write it in PNL, SPL. Consolidated financial statement, उसमें step 1 net assets, step 2 goodwill or capital reserve, same way, the way we used to do it in holding. Step 3 calculation of investment which will appear in CBS. How will you calculate? Share of net assets, add goodwill, okay, cost less, add share of post profit less dividend received. I told you, no, 100 rupees is my investment, correct? Plus I want post profit ka share 120. So how much I want from my associate? 120, out of which they have given me 5 rupees as dividend. So how much I still want? 150. This is the investment that will appear in balance sheet. Step 4, I will prepare CBS. CBS I will write investment 115. Then step 5, I will prepare CPL. CPL I will write share of post profit 20. Bas. Then I will write disclosure mein dividend received 5, transfer to investment 5, which I have transferred here. Just uska disclosure. Am I clear? Yes, sir. This is your associate. Nothing more. Associate is very simple. Thereafter chartered. After associate we have joint venture. Now chartered, there are joint venture ka 3 parts. First of all, what is the meaning of joint venture as per AS 27? A contractual agreement whereby 2 or more parties undertake an economic activity. 2 or more, it is an agreement whereby 2 or more parties undertake an economic activity which is subject to joint control. It's an agreement whereby 2 or more parties undertake an economic activities which is subject to joint control. That is known as joint venture. Correct? Parties are known as venturer or co-venturer. There are 3 types of joint venture. One is jointly controlled operation. Second is jointly controlled asset, and the third is jointly controlled entity. Jointly controlled operation chartered. Jointly controlled operation chartered is nothing but they start a business, one transaction business. When I say one transaction business means they purchase, they incur expense, they sell, they incur expense, they generate profit, share profits, game over. This is a single transaction. Correct? Or they buy land, they construct flats, they buy land, incur expense, construct flats, sell flats, transaction is over. This is known as jointly controlled operation. They met for one operation. What was the operation? Purchase and sale of, suppose, I'll give you an example also. What happened? Long ago, one of my friend who was a dealer in Sony televisions, He came to me and told that, Dipesh, are you interested in business? Matlab, what kind of business? Bola, Sony television is stopping its plasma televisions. Bola, okay. Plasma Sony ka was available at 12,000 in the market. Bola, okay. Bola, maximum retail price is 12,000. People generally don't get it below 12,000. Hardly few people get it from shops at 11,000. Otherwise, everywhere it is available for 12,000 only. I told, okay. Bola, company is shutting down its plasma operations. Bola, okay. So they are ready to sell those televisions at 3,000. Bola, ha? Bola, ha. 3,000 per television. Bola, okay. So what is the problem? You buy and sell, no? Because even if you buy at 3 and sell it at 6,000, for customers 12,000 ka stuff is available for 6,000, no? So still 50% discount for customer and 100% profit margin for you, because 3,000 mein you are buying, selling at 6,000, so still markup is 100% for you and margin is 50% for you, no? Cost plus profit is 3,000 per 3,000 profit, that is markup is 100%, or 6,000 selling price per 3,000 profit, that means margin is 50%. Whatever you say, chartered. I said, go ahead. Bola, Dipesh, the problem is they have got 1,000 pieces and I need to buy 1,000 pieces at one go. He said, oh, so 1,000 pieces into 3,000 is equal to 30 lakhs. I said, what is the problem? Well, I want this 30 lakhs. Well, we'll share profits 50-50, Dipesh. You give me 30 lakhs, guarantee all televisions will be sold within a period of 3 months. Hamla, how? Bola, 1,000 television in 3 months basically means every month I have supposed to sell 340 televisions. I said, yeah. In every month there are 30 days. Maine kaha, yes. Bola, that means every day I am supposed to sell 11 televisions. Maine kaha, yes. Bola, entire Bangalore mein, Dipesh, I will not be able to sell every day 11 televisions at half the price. I know all the shops in Bangalore. I told, good deal. He told, 3 months I will close the deal. Dipesh, we will share profits equally. Maine kaha, done. How much is the minimum profit you are commenting? Bola, 3,000. We buy. We sell it for minimum 5,000. Some customers will sell it at 6. Some shopkeepers will sell it at 5. They will sell it to consumers at 6. No? Bola, okay. 2,000 is the profit per television minimum into 1,000 television, that is 20 lakhs profit. Let's me assume the page 2 lakh expenses, so 18 lakhs ka profit. This 18 lakh ka profit mein 9 lakhs is yours, 9 lakhs is mine. I have to invest only, nothing else. I have to give him 30 lakhs. I thought 30 lakhs per 9 lakhs return. So 9 lakhs divided by 30 lakhs. That is 30% return. Over a period of 3 months, that means 1 month ka interest is 10%. I said done. Done deal. So we entered into this transaction. So I gave him 30 lakhs. He purchased the television. He incurred expenditure, sold the television, and maybe shared the proceeds. This is known as jointly controlled operation. Like this, we have joined hands together here and there whenever he was in need of, he had business idea and I had money. Oh, that is known as jointly controlled operation. In this jointly controlled operation chartered, we prepare a memorandum or draft PL account to find out what is the profit. Then I will prepare joint venture account to find out how much I am supposed to receive or pay to my friend. My friend will prepare joint venture account to find out how much he is supposed to receive or pay to Dipesh. Achha, so jointly controlled operation mein we will prepare memorandum, profit and loss account. Then he will prepare joint venture account to find out how much it is receivable or payable to Dipesh, and Dipesh will prepare joint venture account with friend to find out how much is receivable or payable to him. Okay. Jointly controlled asset. Jointly controlled asset means I and my friend wanted to do some business. Cheers. I and my friend wanted to do some business. But I was involved in teaching. He was involved in his business. So it was very difficult for us to do a business together because we both hardly had time. So what we did, we purchased a property. That property had stage, seating arrangement, and a place where they could party, a kitchen, where they could have a buffet, food. So we started giving that hall for conferences on rent. Then we started giving that hall for marriage parties. We started giving that hall for annual functions, for parties. So lot of places that property was getting booked for marriages, for conferences, for stage shows sometime, for parties, because it had party area, it had an amphitheater, and it had a buffet place. So party area mein they could hold conference, or they could hold conference in the theater, amphitheater, and they could have food in the buffet area where you could eat, where there was a kitchen attached. So we created that property. We invested money little, I invested little, he invested, and we created that property. That property we used to give it on rent and generate income. So that is jointly controlled asset. Or chartered, another example I can give you. We both started a classroom, created a classroom. He was teaching science and I was teaching commerce, but we both were wonderful friends. So I used to teach in the morning, he used to teach in the evening. So there was a jointly controlled asset for us, where we paid the money to create the asset. We were incurring expenses to maintain the asset. But my income, I used to take home. His income, he used to take home. That is also jointly controlled asset. So either we can have a jointly controlled asset and generate income from outside, or we can have jointly controlled asset where we both are using it for our own purpose. This we find in doctors also. You are also doctor, but I am also doctor. We started a clinic together. So it's a jointly controlled asset, where you are a dentist, or suppose you are some specialist, I am some specialist. You take your income home, I take my income home. Whatever is the maintenance, that we share it equally. Oh. Now chartered. In this case, we will prepare a CBS for jointly controlled asset, and then each venture in its separate financial records. So we will prepare a CBS. Then in my balance sheet and my PL, I will show my share of expense and my share of asset. In your balance sheet, you will show your share of asset and your share of expenses. Okay. There will be a CBS of the joint venture. Okay. Yeah. Then chartered, in my financial statement, I will show my share of asset and my share of expense. In your financial statement, you will show your share of asset and your share of expenses. Correct. Third is jointly controlled entity. That means I have a business unit, you have a business unit. We combine and create one common business unit entity where we do business. So it's a properly jointly controlled entity. Over here we met for operation. Over here we are controlling an asset which helps us to generate income. And over here we have instead of we two individuals entering into partnership, here we have two business houses entering into Maruti and Suzuki, Hero and Honda entering into partnership. Here we prepare CPL and CBS for the venturer, and balance sheet with partial consolidation. Partial consolidation means in my balance sheet I will show my assets plus my share of joint venture assets. You will show your assets plus your share of joint venture assets. Correct? Yes, sir. That's all for your joint venture chartered. With that we come to complete consolidation. AS 21, 22, 23. Accounting for income tax. That is deferred tax chartered. Now listen. Suppose one minute. deferred tax. Now chartered, what is this AS22? Now AS22 का heading is income taxes. AS22 का heading is income tax. Suppose if I tell you income 100 rupees in year 1, 100 rupees in year 2, correct? Expense 70 rupees in year 1, 70 rupees in year 2. So profit before tax is how much? 30, 30. Now chartered, expense of rupees 30 of year 1 expenses of rupees 10 of year 1 paid in year 2. Income tax allows this expense on cash basis. So there was an expense of year 1 of rupees 10. Accrual basis में year 1 में 10 rupees के expenses, but I paid in year 2. So income tax is allowing such expense on payment basis. Tax rate is 30%. So my objective is to calculate current tax expense. Current tax expense. Am I clear? So how will I do it? I will say profit before tax how much? 30 add income, expense disallowed. How much? 10. So taxable income is how much? 40. Is 40 per tax rate? 30%. So how much should buy income tax? Current tax expense 12 rupees. So my current tax expense is 12 rupees. Correct? Entry I will pass is PL to current tax expense. But according to me, tax should have been 30% of 30 rupees. According to me, tax should have been 30% of 30 rupees, 9 rupees only. But I am paying how much? 12 rupees. How much extra tax I am paying? Sir, you are paying an extra tax of 3 rupees. Exactly. I am paying an extra tax of 3 rupees. That extra tax of 3 rupees which I am paying, can I say that is prepaid tax? Yes. Deferred tax expenditure. Prepaid tax means deferred tax only. Yes. How much? Deferred tax asset बोल देता है. How much? 3 rupees. The entry will become deferred tax asset to PL. 3, 3. PL is credited, PL is increasing. So I got how much? 30 minus 12, 18, 18 plus 3, 21. This is my profit after tax. Correct? Next year, profit before tax 30. Income tax will allow 12 rupees expenditure in the current year. So according to them, taxable income is 18. Because I paid 10 rupees expenditure in year 2. So income tax will allow in year 2. Yes. 30%. So current tax rate is 5.4. Current tax rate is 5.4. Now, sorry, 30 rupees. That 10 rupees expenditure which they did not allow in the previous year, will they allow in the current year? Yes. So current year ka income is 20 because I paid expense of 10 rupees which was of last year in year 2. Year 1 ka expense I paid in year 2. So year 1 mein it was disallowed, year 2 mein it will be allowed. Into that 30%. So according to them tax is how much? 6 rupees. PL to CTE 6. Now last year ka 3 rupees, but according to me the tax is how much? 9. Yes or no? According to me tax is how much? 9. But how much I am paying? 6. So 3 I am paying less. Why? Because earlier I had paid 3 at extra. According to me tax is how much? 9. But I am paying how much? 6. So I am paying 3 less. Why am I paying 3 less? Because last year I had paid 3 more. So that DTA ka benefit I got it. So PL to DTA 3 rupees, 3 rupees. So again 21. So now you understood that chartered income tax calculates tax on taxable income, whereas accounts calculates tax on accounting profit. Tax on taxable income is not equal to tax on profit before tax. Oh, why? Because expenses and incomes are not accounted in accounts and tax in the same fashion. Sometimes accounts says accrual basis, tax is na cash basis. In some cases account says accrual cash basis, tax is na accrual basis. In some cases account says expense in current year, tax is na expense over a period of 5 years. In some cases account says expense, tax is na asset. So chartered, there is a difference between tax as per taxable income and tax on PBT. Why? Because of this of income and expenses. Correct? Yes. Because of that, we either land up paying extra tax in the current year, which will set off in the future year, or we land up paying less tax in the current year, we'll pay more tax in future year. Yes. So chartered, DTA is something which we say extra tax in current year, but save tax in future. Save tax in future, therefore asset. DTL, less tax in current year, more tax in future, more tax in future, that is DTL. Correct? Now chartered. Now chartered. This is known as DTA or DTL, put together is known as deferred tax expense. Correct? Yes. Now, so this standard helps us to calculate current tax expense and deferred tax expense. Deferred tax expense can be asset, can be liability. So this is how our statement of PL looks. Current tax expense is equal to tax rate into taxable income. And how to calculate taxable income? Profit before tax, add expense disallowed, less income disallowed, add income allowed, less expense allowed. Taxable income, you will get current tax expense. Deferred tax expense, DTE, that is future tax rate. If future tax rate is not given, then current tax rate. So why future tax rate? Because we are going to save tax in future or we will pay extra tax in future. That will be at first future tax rate only, no? But future tax rate we should know in the current year. If you know it, very good. If you don't know, then current tax rate. Into timing difference. What is timing difference? Just now we understood that one expense was allowed in accounts as well as income tax both. but accounts allowed on accrual basis, tax allowed on cash basis. Account says it is an expenditure of year 1, tax said nah, it is an expenditure of year 2. So did both allow an expenditure? Yes, but both ka timing of recognition was different. Account was recognizing in year 1, whereas income tax was recognizing in year 2. That means there will be deferred tax expense because of such timing difference. Expense and income are both recognized in accounts as well as income, but on different timing. Okay, also known as temporary difference. Now charted. Difference arising as per PBT and taxable in temporary due to certain income or expense which are allowed in accounts in current year but allowed in tax in later years or vice versa. That means timing of recognition in accounts and tax is different. But there are some income and expenditure which are permanent differences. For example, provisions for doubtful debts, or rather for that matter any provision, is allowed as expenditure in accounts, but it is never allowed. So there is not a timing difference, it's a permanent difference. Donation is allowed as expenditure. Donation is allowed as an expenditure in accounts, but it is disallowed in tax. So charted, there are certain areas where it is allowed as expenditure in accounts, but not allowed as expenditure in tax. Those are known as permanent differences. Due to certain income or expense which are allowed in accounts in current year, but never be allowed in tax or vice versa. Example, penalty, donation, cash payment in excess of 20,000. These are all allowed expenditure in the accounts, but disallowed in tax. These are permanent differences, and we are creating deferred tax on timing or temporary differences. Timing or temporary differences means both may it is treated as an expense, but at different point of time. Both may it is treated as income, but at different point of time. Permanent differences may it is treated as expense in one, but it is not treated as expense in another at all, or vice versa. Am I clear? Yes, sir. Now charted. These are those differences which originate in 1 year. This is very, very, very important. Deferred tax. These are those differences which originate in 1 year, 1 period, and are capable of reversal in subsequent years. So deferred tax you will create only when you are confident that you will be able to reverse in future. Like when I created deferred tax on expense, I was sure it will be reversed in the year when I pay it. But donation, if I create deferred tax, I will never be able to reverse it. Why? Because donation will never be treated as an expense in tax. Acha. So these are those differences which originate in 1 period and are not capable of reversal subsequently. Am I clear? Yes. Deferred tax expense and deferred tax liability. Paid more in current year and thereby save tax in future. Paid less in current year and thereby pay tax, extra tax in future. Correct? Tax expense. Now charted, if this is very, very important, I'll now hit on concepts only. Deferred tax, expense in accounts, expense in tax. Expense in accounts, expense in tax. If expense in accounts is more in the current year and tax my expenses are less. If tax my expenses are less, tax my profit is, expenses in accounts are more, it means tax may we are charging less expense, tax may we are charging less expense. Therefore tax my profit is more. If tax my profit is more, we are paying more tax in the current year. If we are paying more tax in the current year, we will save tax in future. Therefore, we should create DTA. Sir, come back. Account says 10 rupees expense. Tax says 2 rupees expense. So, income tax may less expense by how much? 8. So, income tax may profit is more by 8. If profit is more by 8, then 30% of 8 rupees, 2 rupees 40 paisa, I am paying extra tax in current year. The tax which I am paying extra in the current year, I will save in future years. Yes, that saving in future tax is known as That saving in future tax is known as deferred tax asset. So if expense in accounts is greater than expense as per tax, you will create DTA. But accounts में expense is less, tax में expense is more, tax में expense is more, profit less, that means in current year you are paying less tax. If current year में you are paying less tax, future में you have to pay more tax, then you will create DTL. So accounts is more than DTA, tax is more than DTL. Expense में, if accounts is more, DTA, if tax is more, DTL. This is in first year only. See, expense, accounts is more, DTA, tax is more, DTL. Okay, correct. But second year में charted game will change. Second year, expense. Second year expense charted. If accounts is greater than tax or accounts is less than tax. Second year में if accounts is greater than tax charted, it would be reversal of DTL. हाँ. First year में accounts is greater than DTA. Second year में accounts is greater than reversal of DTL. Accounts is less than tax, reversal of DTA. Now I would request that don't go into too much of logic because exams are coming very near. When I post revision videos, then you will come out with logic. Now you remember, first year में accounts is more DTA, tax is more DTL. Subsequent years में accounts is more, reversal of DTL. Yo Rama, DTA, reversal of DTL, yes. DTL, reversal of DTA. Correct? Yes or no? Yes, sir. Now charted, in case of income, see over here, I have proved it. Expense as per account 600, expense as per tax 200, 200, 200. Who is greater over here? Accounts is greater. Accounts is greater, so you created DTA. Over here, what is greater? Tax is greater. If tax is greater, you should have created DTL, but you reversed DTA. Tax is greater, then you should have created DTL, but you have reversed DTA. Hana? Similarly, see, tax is greater, you have created DTL, but accounts is greater, you should have created DTA. So this was an example I explained. Therefore, conclusion, tax and accounts. Year 1, create DTA, year 2, reverse DTA. Create DTL, reverse DTA. Create DTA, reverse DTL. Understood? Yes. Then chartered. In case of income, it is reverse. Accounts में, expense में if accounts is greater, DTA, tax is greater, DTL. Income में if accounts is greater, DTL, tax is greater, DTA. Expense में, expense accounts greater, DTA, tax greater, DTL. इनकम में अकाउंट्स ग्रेटर, DTL, टैक्स ग्रेटर, DTL, DTA. Now chartered, in case of loss, carry forward of loss, you will create DTA, Why? Because if there is loss in the current year, that loss you will be able to carry forward in future years. Yes. If you are able to carry forward that loss in future year, that means future year ka income में से you will subtract that loss. Yes. If you subtract that loss, that means you will save tax in future. Yes. That means you will create what? DTA on loss. Correct? But DTA on loss you will be able to create. DTA on loss you will able to create only if chartered. Only if you believe that in future there will be sufficient income to set up the loss. Oh, yes. See. In year 1, entity should have created DT on taxable loss, provided the entity has convincing evidence. Provided that entity has convincing evidence that in future year, entity would have sufficient taxable income to set up the loss. Then you will create DTA on amount of taxable loss. You should have convincing evidence. Thereafter chartered, MAT, minimum alternative tax. Now, understand this. Accounting profit 9 lakhs. Book profit as per MAT. That means tax authorities have calculated tax 5 lakh 25. Profit as per income tax 95. Tax rate 30%, MAT rate 7.5%. So chartered CTE will be 30% into 95,000, 29,500. Huh? Now chartered deferred tax will be tax on accounting profit 30% of 9 lakhs. According to accounts, tax should have been 2 lakh 70, but income tax is saying 28,500 to DTL. Correct? That means chartered, we can say in case MAT में we will create DTL. MAT में we will create DTL. Tax rate into accounting profit minus taxable income. Accounting profit will be more, taxable income will be less. So we will create DTL. Okay. And provision will create on MAT rate MAT rate into MAT profit. MAT rate into MAT profit. Correct? Now, why I am doing this, I will tell you. MAT rate into MAT profit minus CTE. So chartered, if anybody asks you what is deferred tax, what you are supposed to study, then chartered, it is hardly anything. First year, in expense, rather ऐसे करते हैं, in case of expense, first year, accounts greater than tax, DTA, accounts less than tax, DTL. Second year, accounts greater than tax, reverse DTL, because the journal entry is same. DTA to PL, DTL to PL. Oh, accounts less than tax, reverse DTA. B, income, vice versa of expense. C, chartered, in case of loss, DTA is equal to tax rate into carry forward loss. But you should have convincing evidence that there will be profit in future. 4 chartered, DTL, in case of MAT, DTL is equal to tax rate into accounting profit, PBT, minus taxable income, and provision is equal to MAT rate into MAT profit minus CTE. That will give you provision. Correct? And apart from that, you are supposed to remember SPL ka format. This is all about your deferred tax chartered. These are the only points you are supposed to remember in deferred tax. Correct? With that, we come to end of deferred tax also chartered. Now chartered discontinued operation. Discontinued operation में this point is important, this point is important, and this point is important. 3. Ready? Yes, sir. First of all, what is discontinued operation? Listen to me very, very carefully. Discontinued operation means, first of all, any operation means it is a component of an entity which represents component, unit, division, segment, whatever you call it, which represents a separate major line of business or geographical area of operation. It is a separate unit. It is a separate unit of entity which is, it is a component of a unit which has a separate line of business or geographical area of operation. It is a component of an entity which has a separate major line of business or geographical area of operation. It is a component of an entity which has separate major line of business or geographical area of operation. That is what? Operation. Acha. So this much I understood, sir. It is a separate, it is a component of an entity which is a separate major line of business or geographical area of operation. What you studied in AS 70. Correct. Now chartered is discontinued. And how can you separate it? And it can be separated or distinguished, identifiable for operational purpose and for financial reporting purpose. So see, the slowly definition will settle down. It is a component of an entity which is a separate major line of business or geographical area of operation which can be separated matlab distinguished or identified for operational purpose, admin purpose, and for financial reporting purpose. That means for books of accounts also. But that means you can find out its income, expense, asset, liability, everything is discontinued as per single plan. So it says component. It is a component. It is a component of an entity. It is a component of an entity which is a separate major line of business or geographical area or operation which can be separated for operational and financial reporting activities and is discontinued as per single plan. Discontinued as per single plan means either sold or demerged, or chartered, sold the assets and liabilities in pieces. So, piecemeal distribution or abandonment, that means you have stopped the work. Correct? Now, discontinued as per single plan. Single plan means any one of the three plans. That means selling substantially in total either in single transaction or that means either you sold it or demerged it. Selling of components, that means assets and liabilities are sold in piecemeal distribution. Terminating through abandonment, that means you have shut down the operations, you have not decided what you will do with it future. Am I clear? Yes, sir. So, you entire what is discontinued operation ka definition. It is a component of an entity which is a separate major line of business or geographical area of location which can be separated, distinguished and identifiable for operational purposes and financial reporting purposes, is discontinued in a single plan, either by selling or demerging or in piecemeal distribution. Sold the assets peacefully, liability is paid off peacefully. Peace, not shanti, peace. And or by abandonment, that means you have shut down the operations. Following are not treated as discontinued operation. 5 situations. Situation 1. Gradual phasing out of a product line is not a discontinued operation. That means Tata Motors previously were into petrol and diesel cars, now shifting to EV. That is not a discontinued operation. They are still into cars. Shifting of marketing and product activities to a different location. Tata had started in Singur, Bengal. Now they had shifted to Sanand, Gujarat. So that is also not what? Discontinued operation. Closing down of facility to achieve productivity improvement and other cost saving. Toyota closed its production facility and now producing at Maruti facility. So now Toyota is not producing cars in India, especially Glanza you would have heard. It is nothing but Baleno only. So they are producing in Baleno facility. Branding is done by Toyota and sold by Toyota. So Toyota has closed down its production facility and doing it through Maruti. So that is cost saving. Is Toyota operations shut down? No. Change in scope of business. I had a physical restaurant, then I shifted to online cloud kitchen. Am I still selling food only? Selling subsidiary whose activities are similar to that of holding. Parent was Ola Cab, subsidiary Meru Cab. Meru Cab, they shut it off. Does it mean their cab service have stopped? No. So that means that a gradual phasing out, shifting of marketing, closing down of one facility, changing of operations and selling of subsidiary. All these are not considered as discontinued operation. Disclosure, initial disclosure event. Board of Directors approved 15th April, announcement date 18th April, binding sale agreement for 25th. Now, earlier of the following, Board of Directors approved, announcement date, binding agreement. Now, entering into binding agreement or resolution of discontinuing operation is approved board meeting and announced by the company. So, announced by the company is 18th or 25th, whichever is earlier. That is initial disclosure date, and these are the disclosures you are supposed to make. That is your AS 24. Correct? What is discontinued operation? What is not discontinued operation? Which is the initial disclosure event and what you are supposed to disclose? Correct? Yes. AS 25. Interim financial reporting. Now charted interim financial reporting. Interim financial reporting में chartered. Interim financial reporting में you are supposed to learn how to prepare financial statements of a period which is less than 1 year. There is no standard which mandates preparation of interim financial statement, but if you are preparing interim financial statement, you are supposed to follow AS 25. So any financial statement lesser than 1 year is known as interim financial statement. There is no standard which mandates preparation of interim financial statement, but if you prepare interim financial statement, you are supposed to follow AS 25. Now charted. Suppose your interim period is 1/7 to 30th September, that is Q2. Then you are supposed to prepare balance sheet on which date? 30th September, previous year 31st March. So balance sheet current period ka you will prepare on 30th September, but previous period ka you will not prepare on 30th September 22. Previous year ending, as on the end of the immediately preceding financial year, 31st of March 23, correct? PL account, 1/7 to 39, 1/4 to 39, that means current interim period plus cumulative interim period. 1/7 to 39 and year starting to the end of cumulative period. Am I clear? So 2, same period of next year. 1/7 to 30th September, 1/4 to 30th September also. So 2, 3 months and year starting to end. Okay. So next it will be again 3 months, but year starting to end 9 months. If you understand this, so year starts on 1/4, 30th June, 30th September, 31st December and 31st of March. This is Q1, this is Q1. Now charted, this is Q2, this also you will prepare. Oh, then you will prepare Q3, then this also you will prepare. Q3, correct? Then this also you have to prepare. Then Q4. Then this also have. So 2, year starting set till the end, that is known as cumulative period of current as well as comparative. Cash flow statement only from year starting up to date, year starting to 30th September. Balance sheet as on that date, but comparative ka last year ending balance sheet. PL 3 months plus year starting to end. Cash flow statement year starting to end. Am I clear? Yes. Some important points. Those important points are charted. That every accounting period is considered, every quarter is considered to be a complete accounting period. You are supposed to recognize asset, expense, income, liability on the basis of that only. Each period is a complete period. So 3 months ka period is 3 months ka period. Closing stock, opening stock, income, expense, exactly. 3 months ka period, you have paid 4 months ka expenses, that means 1 month is prepaid. 3 months ka expenses, you have paid 2 months ka, 1 month is outstanding. 3 months ka depreciation, everything for complete 3 months. Each interim period should be treated as a separate accounting period. The entity should apply the same accounting policies in the interim period that are being followed for the annual period. Achha. An item which will be recognized as an asset, liability, expense or income only if it fulfills the criteria of recognition in the financial statement. An item will be recognized as an asset or liability, income only if it fulfills the criteria. That 3 months. More than 3 months asset, less than 3 months outstanding, same. Revenue received seasonally or occasionally should be neither anticipated nor deferred. I have received dividend in the current year, current quarter. I cannot say that dividend belongs to all 4 quadrants segregated. So whichever quarter I receive income, I will record it. Profit on sale of asset, I received in Q3. I cannot say this is for the whole year and bifurcate it equally in all the 4 quarters. No. So income, which is of whichever quarter you record in that quarter. You cannot prepone it to quarter 1 and quarter 2. You cannot postpone it to quarter 4. Am I clear? Costs that are incurred unevenly during the year should not be either deferred. So I am incurring cost randomly. I cannot say add all the cost and divide it equally. It cannot be preponed, it cannot be deferred for cost also. Am I clear? Yes. And charted, most important, tax expense of current year is equal to weighted average tax rate into profit before tax of interim period. Weighted average tax rate means expected tax expense in entire year by expected income in entire year into 100. This is expected. That is my weighted average tax rate. On that weighted average tax rate, I am supposed to calculate tax of current year. I understood. Total annual tax expense by total annual PBT. Tax rate should be based rates related to the applicable business and profession का rate, capital gain का rate. Am I clear? With that we come to end of AS 25 chartered. AS 26 is intangible, that is cut, copy, paste PP. There is no difference. PP and intangible are same. AS 28 impairment. Now chartered, impairment will stick to whatever institute has done. Impairment means decrease in the value of asset. Decrease in the value of asset. Why? Because its recoverable amount has gone down. What is recoverable amount? Its benefit deriving capacity has gone down. How do you derive benefit from that asset? Either by sell, either by sale or by use. Either by sale or by use. Correct? Yes, sir. So, recoverable amount is higher of net selling price or value in use. Net selling price is nothing but selling price less cost to sell, and value is use is nothing but present value of future cash flows plus present value of salvage. So, if recoverable amount, if carrying amount is 10, recoverable amount is 8, then we can say asset is impaired to the tune of 2. That means chartered standard was trying to say that you cannot show any asset in balance sheet beyond its recoverable amount. So, if recoverable amount is 8, you cannot show beyond 8. You can show below 8. Am I clear? Yes, no. The difference is known as impairment loss. How to account for impairment loss? Impairment loss to provision and revaluation reserve, impairment loss, revaluation reserve PL to impairment loss. So, first you will take impairment loss from revaluation reserve, extra you will take it from P&L. Correct? Yes, sir. Now chartered. Now chartered, one more thing in case of impairment loss. This is one. Second thing is, suppose there is a revaluation reserve of 100 rupees. Before revaluation, we were charging depreciation of 10 rupees. After revaluation, we are charging a depreciation of 15 rupees. So, because of revaluation, how much depreciation has increased? 5 rupees. That can be subtracted from revaluation reserve every year. Oh my God. So, extra depreciation because of revaluation may be subtracted from revaluation surplus if the organization opts for. So, revaluation reserve available for this depends whether the entity has opted for setting of excess depreciation through revaluation reserves. Am I clear? So, chartered step 1, if you ask me, step 1, calculate carrying amount as on date of impairment. Step 2. ऐसे करते हैं, बेटर रहेगा. Step 1, calculation of impairment loss. A, carrying amount as on date of impairment. B, recoverable amount as on date of impairment. Higher of net selling price, value in use, that is present value of future cash flows. If recoverable amount is higher, then there is impairment loss. Correct? Step 2, accounting. Impairment loss ill to pill and revaluation reserve PL account debit to impairment loss. Correct, chartered? Why this much? One minute. Revaluation reserve PL to impairment loss. Correct? Now, but revaluation reserve ko remove. If there is an excess depreciation set off against revaluation reserve, then revaluation reserve will keep on decreasing. Step 3. Step 3 is revised carrying amount. That is, carrying amount minus impairment loss is revised carrying amount. Step 4 is depreciation. Now charted depreciation is equal to revised carrying amount divided by remaining life. For examination perspective, only this much is important because the institute has discussed this much only. Am I clear? For as far as impairment is concerned. Yay! Provision contingency, come to this chart. Now let's read. AS 29, provisions, contingent liability and contingent asset. 1 minute, chartered. Now, the objective of AS 29 is to ensure that appropriate recognition criteria measurement is applied to provision, contingent liability and contingent asset. It is applicable to provision in nature of liability and not applicable to provision for doubtful debts AS 4 and AS 9, provision for depreciation, provision for impairment loss, construction, all these things, but is not applicable. What is obligation? Are those events for which entity has no realistic alternative other than settling it. What does the word obligation mean? I have to pay. I don't have any other realistic alternative of not paying it. If he says don't pay, fair enough, but I cannot avoid it. So this is very, very important definition. No realistic alternative other than settling it means obligation. Types of obligation: legal obligation, constructive obligation. Legal obligation means through law, bill. Constructive obligation means past practices, published policies, that. Dipesh sold goods to Rita for 10,000. Case 1, it was mentioned in the invoice that entire money would be refunded without any question asked. Legal obligation. It was mentioned on the board inside the shop. Constructive obligation. It was established practice of Dipesh from past 10 years. Past practice. Constructive obligation. Loan from bank. It's an obligation. Loan from bank is an obligation. Legal obligation. Bonus to employee. It's a legal obligation. Now chartered obligations are broken into three parts. First is present obligation. Second is possible obligation. Third is remote obligation. Now you understand. Present obligation means greater than 50% to 100%. Greater than 50% to 100%. That means it includes certain 100%. It includes probable greater than 50% but less than 100% chances of paying it. Possible obligation less than 50% chances of paying it. Remote obligation chances of paying are less than 5%. So how many types of obligations are there? Three. Present more than 50% equal to 100%, less than 50% less than 5%. More than 50% is present obligation, less than 50% is possible obligation, and more than less than 5% is remote obligation. Past event. For an obligation to arise, there should be an event. You cannot have a obligation or liability to pay without there being a past event. Correct? Yes. Outflow of economic resources means amount payable. Outflow of economic resources means amount payable. That can be certain, that cannot be probable, that can be probable. Certain means certain and known, that I am supposed to pay 100% and I know how much I am supposed to. Probable and can be reliably estimated. That means chances of paying are more than 50% and I can estimate also how much. Not probable. That means chances of paying are less and reliable estimate cannot be made. So there is three things. Certain, probable and reliable estimate can be made. Probable and reliable estimate cannot be made. Oh, yes, probable and reliable estimate cannot be made. Probable means chances of paying are more than 50% but not 100%. Certain means chances of paying are 100% and amount is known. Probable means chances of paying are more than 50%, tends to 100%, but amount payable, I don't know exact. But can you estimate it? Yes. Amount payable, I don't know exact, but can you estimate it? No. Now this is the crux. This, if you remember, your things are done. Present obligation, amount is certain and known, it's a liability. Present obligation, that is greater than 50%, probable. That means outflow of economic resources is probable and can be reliably estimated, then it's a provision. Present obligation, probable, reliable estimate cannot be made, it's a contingent liability. Possible, I am not interested. Obligation is possible, contingent liability. Obligation is remote, ignore it. This is Dipesh sir special. If present obligation, certain and known, liability. Present obligation, probable and reliable estimate can be made, provision. Present, probable and reliable, contingent liability. That means greater than 50% you can estimate, then it's a provision. Greater than 50%, but you cannot estimate, it's a contingent liability. If the obligation is only possible, that means chances of paying are less than 50%. Amount does not matter only, contingent liability. Remote, less than 5%, amount does not matter only, ignore it. Am I clear? Yes or no? Yes, sir. That's all for your AS Marathon. Thank you so much. I could not take classes regularly because I met with small accident. I'm really very sorry. Thank you so much for being there with me. All the very best. Within next 2 to 3 days, I'll tell you which chapters to put more stress and how the paper pattern would be. Thank you so much. All the best. See you soon.